idea. A business must only pay money out when the payment is correct, approved, and properly supported by documents. If receipts are the money coming in, then payments are the money going out, and payments are where many businesses lose money through mistakes, fraud, or weak controls. This is why Chapter 8 is so important. What we will study in Chapter 8. 1. Controls over payments. You will learn the basic control rules that keep payments safe and accurate, such as authorization, who is allowed to approve a payment and what approval really means. Segregation of duties. Different people should request, approve, and make the payment. Supporting evidence. You do not pay without proof, such as an invoice, an agreement, or a verified claim. Record keeping. Every payment must be traceable from the document to the accounting records and to the bank activity. 2. Check requisition forms. You will learn how businesses formally request a check, including why a requisition exists to stop random or unauthorized checks, what details must be included, payee, amount, reason, cost code, authorizer, how it creates an audit trail from request to payment. 3. Expenses claim forms. You will learn how staff expenses are controlled, including what counts as a valid expense claim and what does not, why receipts and evidence are required, approval rules and limits, common errors that cause overpayment or fraud. 4. The timing and methods of payments. You will study how businesses decide when and how to pay, including paying too early versus paying too late, cash flow impact, supplier relationships and credit terms, choosing the most suitable payment method for the situation. 5. Payments by cash. You will learn when cash payments are allowed and how they are controlled, usually with petty cash limits, vouchers and receipts, safe custody and reconciliation. 6. Payments by check. You will learn the practical steps and controls for check payments, such as preparing the check correctly, getting the right signatures, recording the payment properly, preventing loss, alteration, or misuse. 7. Bank giro credits, also called credit transfers. You will learn about payments made through the banking system directly to the supplier or employee, including why they are widely used, speed and security, what evidence supports the payment instruction, how they appear in bank records. 8. Payments by banker's draft, also called payable order. You will learn why a business might use a banker's draft. For example, when the payee requires guaranteed funds, when a business wants a secure method that is not a personal check. 9. Payments by standing order and direct debit. You will learn the difference clearly. Standing order. The business instructs its bank to pay a fixed amount regularly. Direct debit. The supplier collects funds with the business's permission. You will also learn the key risks and controls for each method. 10. Documentation to go out with payments. You will learn what should be sent with a payment so the supplier can match it, such as remittance advice, references and invoice numbers, details that reduce disputes and delays. Why Chapter 8 is important. It protects real money. Most financial losses in small and medium businesses happen because of paying the wrong supplier, paying the wrong amount, paying twice, paying fake invoices, staff claiming non-business expenses. Chapter 8 teaches the controls that prevent these. It is essential for strong accounting and exam success. In exams, you are often tested on whether you understand what document is used for what purpose, what control prevents which risk, how to choose the correct payment method, how to explain the process in clear steps. It links directly to double entry and later chapters. If you cannot control and authorize payments properly, then your later records become unreliable, including recording payments in the books, bank reconciliation, supplier balances, and statements. So Chapter 8 is a foundation chapter for accurate bookkeeping. What you should be able to do after this chapter. By the end of Chapter 8, you should be able to describe the full payment process from request to approval to payment to filing. Identify the correct document for each payment situation. Explain the main controls that prevent payment errors and fraud. Choose the most appropriate payment method for a given scenario. Explain in exam style why each control matters. In Chapter 8, we move from receiving money to the other side of the story, paying money out. Payments are risky because once money leaves the business, it is hard to get it back. That is why the book starts this chapter with controls over payments. Lesson 1. What controls over payments means. A control is a rule or procedure that helps a business make sure that payments are real. The business truly owes the money. Correct. The amount and details are accurate. Approved. An authorized person agreed the payment should happen. Secure. Only the right people can actually release the money. Recorded properly, so the accounts and bank balance stay correct. Think of it like a strong door with 3 locks. Even if one lock fails, the other locks still protect the money. Why this lesson is important. This lesson matters because payments are where fraud and errors commonly happen. For example, paying a fake supplier invoice, paying the same invoice twice, paying the wrong supplier, paying the wrong amount, paying for goods that were never received, an employee paying themselves or a friend. In exams, questions often test whether you understand how to prevent these problems using simple internal controls. The book's 3 main steps in controlling payments. The book explains 3 main steps. I will explain each one in plain language and show what it looks like in real life. Step 1. Get documentary evidence for the payment. Documentary evidence means, show me the proof. Before paying, the business must have documents that prove 2 things. Why the payment is being made. How much should be paid. Common examples the book highlights include documents such as supplier invoice, proof a supplier is charging the business, supplier statement, a summary of what is owed, check request form, an internal request to pay, expenses claim form, staff claiming reimbursement. What a careful business checks at this step. A smart examiner expects you to mention checks like these, even if the question does not list them. Supplier name matches the approved supplier records. The goods or services are described clearly. The prices agree with what was agreed earlier. Any tax is treated correctly. The invoice has not already been paid. The invoice is for the business, not for an employee personally. Simple message. No proof, no payment. Step 2. Authorize the payment. Authorization means a responsible person approves it. This is different from documentary evidence. Evidence is proof. Authorization is permission. An authorized person must approve the payment, usually by signing, stamping, or digitally approving the document. The authorized person should be someone with the right level of authority, such as a manager. 2 key ideas the book stresses here. The authorization system should clearly show which individuals can authorize which types of spending, the maximum amount each person can approve. This prevents a junior person from approving a large payment. What the authorizer should be thinking. An authorizer should ask, do we really owe this money? Is this purchase necessary and valid? Is the amount reasonable and accurate? Is it within budget or policy? Step 3. Restrict who can actually make the payment. This step is the money leaving the business step. Even if an invoice is real and approved, the business must still make sure that only specific trusted people can release the payment. Examples of restricting authority include only named signatories can sign checks. Checkbooks are locked away securely. Online banking payments require approval plus release by separate people. Dual authorization for bank transfers, 2-person approval. This step is crucial because it stops a dishonest person from taking an approved invoice and paying it in an unsafe way. Lesson 1.1. Example, controlling a payment. The example in the book shows the difference between the 3 steps using a simple situation. A company buys goods costing $5,000. Now watch how the same payment must pass through all 3 control steps. Step 1 in the example, documentary evidence. The business receives an invoice from the supplier. That invoice is the documentary evidence because it explains what was bought, the amount to pay, which is $5,000, who must be paid. Important idea. At this stage, the invoice alone does not mean pay now. It only means here is the claim. A careful process would also match the invoice to supporting proof that the purchase is genuine, such as a purchase order showing the business ordered the goods, evidence the goods were received and accepted. Even if the book does not show all these extra documents in the small example, this is exactly how you should think in an exam. Proof plus checking. Step 2 in the example, authorization. The invoice is approved by the purchasing director. That approval is the authorization of the payment. It means a responsible person confirms the goods were needed for the business. The supplier is legitimate. The amount is acceptable. The business should pay. This step reduces the risk of paying for something unauthorized. Step 3 in the example, restricting authority to make the payment. Later, the business makes the payment to the supplier, likely by check. But the key control is this: only the finance director or the managing director is allowed to sign the check. So even if someone else tries to prepare a check, they cannot complete the payment without an authorized signatory. This prevents situations like a junior employee preparing and signing a check themselves, a dishonest employee paying a fake invoice by slipping it into the system. The most important learning from the example. Many students mix up these 3 ideas, so remember this. Documentary evidence is proof of the reason and the amount. Authorization is approval to pay. Restricting authority is controlling who can actually release the money. In strong control systems, these are often done by different people. That is called segregation of duties, and it is one of the best anti-fraud controls. How to answer similar exam questions. When the exam asks about controls over payments or how to control payments, use this structure every time. First, documentary evidence. Say you must have evidence such as invoice, statement, check request, or expenses claim, and it must be checked. Second, authorization. Say an authorized person must approve the payment, and limits should be set for who can approve what amount. Third, restricting authority to pay. Say only specific people can sign checks or release bank payments with secure control over payment methods. If you write your answer in these 3 stages, you will be covering exactly what the examiner expects from Lesson 1 and Lesson 1.1. 1.2. Authorization. In Lesson 1.2, the book is teaching you one key control idea. No payment should be made unless an authorized person has approved it, and that approval must follow clear rules, especially money limits. This sounds simple, but it is one of the biggest topics in real businesses and also in exams because it prevents fraud, errors, and unnecessary spending. Number 1, what authorization really means. In simple words, authorization means official permission to spend the business's money. So before money leaves the business, by cash, check, transfer, card, or any method, someone with the right authority must say, yes, this payment is valid. Yes, we really should pay this supplier or person. Yes, the amount is correct. Yes, this expense is allowed for the business. Yes, I am allowed by my job role and limit to approve this amount. If there is no authorization, then the payment should not be made. Number 2, why the book says authorization procedures must be proper and have written limits. The book stresses 2 things. A, proper authorization procedures. This means the business must have a clear system, not a casual system like just ask anyone who is free, just let the cashier decide, just pay it quickly. A proper system is organized, consistent, and controlled. B, written limits. This means each authorized person must have a written spending limit. So instead of guessing, the business has rules written down like a supervisor can approve up to 100, a manager can approve up to 1,000, a director can approve up to 25,000. A top executive may have no limit. Why written limits matter? People do not argue later. It becomes easy to check if a payment was approved correctly. It stops staff from approving amounts that are too big for their role. Auditors and managers can test the system easily. Number 3, every payment must be approved by an authorized person. What that means in practice. The book explains that every payment should be approved by someone authorized. Usually this person is a manager or a supervisor in the department that started the spending. Example, if the purchasing department ordered goods, someone authorized in purchasing approves the invoice. If the production department requested materials, someone authorized in production approves. If the sales department needs an expense, someone authorized in sales approves. But the book also reminds you, every organization has its own system, meaning some businesses approve centrally, head office approves most things. Some approve by department. Some require 2 approvals for large payments. The key idea stays the same. Approval must follow the rules. Number 4, the 2 core authorization questions. The book lists them. The book highlights 2 control questions that every authorization system must answer clearly. Question 1, Which individuals can authorize particular expenses? Meaning, who is allowed to approve this type of spending? Is it a supervisor, manager, director, or head office? Example, staff wages might need head office approval. Buying inventory might be approved by purchasing. Selling assets might need a director's approval. Question 2. What is the maximum amount that an individual can authorize? Meaning, even if someone is allowed to approve, they may only approve up to a certain amount. So a person might be allowed to approve office stationery, but only up to 100 or 1,000, depending on their role. Number 5. Understanding the authorization table, the authorization matrix. The table in the book is an example authorization matrix. It is basically a decision map that says, if the payment is this big, then these job roles can approve it. It is separated by departments: purchasing, production, sales, and head office. It has different money bands, different spending limits. The key pattern in the table is, the bigger the amount, the higher the person approving must be. Typical levels shown in the table are like this, same structure the book is demonstrating. No limit approvals are only for the most senior people, top leadership level. A large limit such as 25,000 is for senior roles, director level or senior finance level. A medium limit such as 5,000 is for manager level roles. A smaller limit such as 1,000 is for junior manager or grade 2 manager level roles. A very small limit such as 100 is for supervisor level roles. So the table is teaching you hierarchy and control. Small payments can be approved at lower levels. Big payments must be approved at higher levels. Number 6. How to use this idea in exam questions. This is the skill they test. In exams, they test authorization in very predictable ways. Step 1. Identify the amount. Example, the invoice is for 6,000. Step 2. Find the correct limit band. 6,000 is more than 5,000, so someone with a 5,000 limit cannot approve it. Step 3. Identify the department. If the expense is for production, you use the production column in the matrix. Step 4. Choose the correct authorized person. You choose the lowest role that is allowed to approve that amount. Because that is how good controls work. Do not use a director for tiny payments if a manager is allowed. Do not use a supervisor for large payments. Number 7. Common exam traps. What students often do wrong. Trap 1. Approving with the wrong person. Example, a supervisor approves 1,000 even though their limit is 100. Trap 2. Ignoring the department. Example, using purchasing limits for a sales expense. Trap 3. Splitting a payment to avoid limits. This is a control weakness. Example, instead of one payment of 2,000, they make 2 payments of 1,000 to get lower approval. In real controls, this is not allowed, and exam questions may mention it as a weakness. Trap 4. No evidence of approval. In a strong system, approval is recorded. Signature on invoice, stamp approved, electronic approval log, authorized signatory list. If approval is not recorded, it is not a strong control. The big takeaway from Lesson 1.2 authorization is about permission with limits. Right person, right type of expense, right maximum amount, recorded approval. Follow the system every time. In this lesson, the book is teaching you one simple but very important idea. Before a business pays money out, it must have proof, documents, and approval authorization. A check requisition form is used when the usual proof document is missing. Think of it like this. An invoice is the normal document that proves why you are paying and how much you should pay. But sometimes you must pay before the invoice arrives, or you may not receive an invoice receipt at all. In those cases, you still need something written down to control the payment. That something written down is the check requisition form. Number 1. What is a check requisition form? A check requisition form is an internal form that requests a check to be prepared. The book's key message is, it is used when primary documentation, such as an invoice, has not been received. It helps ensure authorization and proper recording of payments. So the form supports 2 controls. A. Authorization control. It forces someone responsible to approve the payment before cash leaves the business. B. Recording control. It creates a document trail so the accounts team can record the payment correctly and later match it to the invoice receipt when it arrives. 2. Why do we need it? The control problem it solves. Normally, a supplier invoice gives you The supplier's name, who you pay, the reason for the payment, what you are paying for, the amount due, how much, often the date, order reference, and payment terms. That invoice is documentary evidence. But the book says there are occasions where payment by check is required, but the invoice receipt evidence is not available yet. Without evidence, paying is risky because someone could request a check for a non-business reason. Someone could exaggerate the amount. The business may pay the wrong person. The accounts team may record it incorrectly. Later, nobody can explain what the payment was for. So the check requisition form is the control replacement when the invoice is missing. Number 3, the 2 situations the book lists. You must know these. The book gives 2 specific cases where a check requisition form becomes necessary. I will explain each carefully. A. The invoice has not yet been received, but payment is required now. What this means, in very simple words, the business knows it must pay. The supplier has not yet sent the invoice. A receipt invoice will probably come later, but the business must pay now. For example, time-critical service, urgent delivery, or advance payment. Why is this situation common? Because real businesses do not always get paperwork on time. The goods service can happen first, paperwork can arrive later. What is the control risk here? If you pay now without any document, you might later struggle to prove why you paid, match the later invoice to the earlier payment, or confirm the amount was correct. How the check requisition form fixes it. It forces the person requesting payment to write down what the payment is for, who it is to, how the amount was calculated, and it gets approval before the check is prepared. Then, when the invoice arrives later, the accounts department can attach it to the requisition, confirm the payment was correct, and file a complete audit trail. B. There will be neither an invoice nor a receipt. This is even more serious, so listen carefully. Some payments happen where there is no supplier invoice and there is no receipt. Examples in real life can include certain official fees, small urgent items, or specific one-off situations depending on the organization. What is the control risk here? If there is no invoice and no receipt, then without a requisition form, the payment could become invisible in terms of evidence, and it becomes difficult to prove it was a genuine business payment. How the check requisition form fixes it. The book explains that the documentary evidence of the reason and amount can be obtained from the person who wants the payment to be made. So the evidence becomes the written explanation on the check requisition form, plus the approval signature showing the organization accepted that explanation. In other words, when external documents do not exist, the business creates internal evidence. Number 4, where does the information come from? The book says, the documentary evidence can be obtained by asking the person who wants the payment made to fill in a check requisition form. This is important. A check requisition form is not just paper. It is a control step that forces responsibility. The requester must be able to answer, why are we paying? Who are we paying? How do we know the amount is correct? Which department is responsible? Number 5, the term, definition in the book. Make sure you can say this clearly. The book explains the idea very directly. A check requisition form is simply a form requesting that a check should be drawn to make a payment. That is the core definition you should memorize for exams. If an exam asks, what document is used to request a check when the invoice has not been received? Your answer is check requisition form. And your explanation is it requests a check and provides evidence and authorization for the payment. Number 6, internal document. No standard design. What this means for you. The book also says a check requisition form is an internal document for use within the business. Therefore, there is no standard design, meaning different businesses will design it differently. But the purpose stays the same: control, approval, and recording. So in practice, a good check requisition form usually contains items like date of request, payee name, who gets paid, amount, reason for payment, clear description, department, cost center, who is responsible, signatures for approval, authorized person, any references, purchase order, email request, contract, etc. Even if the layout changes, these details are what make it useful. Number 7, important note from the book. Checks are going out of use. The book includes a note that matters for modern business. Checks are now going out of use and are often replaced by electronic payment methods. So check requisition forms are no longer widely used. But for your FA1 learning and exam skills, the lesson is still valuable because it teaches the control principle. When you pay, you must have evidence and authorization, even if the payment method changes. So in a modern business, you may see a similar idea as payment request forms, electronic approval workflows, purchase approvals in accounting software. Same control logic, different tool. A check requisition form is used when an invoice is missing. It makes sure payments are authorized and recorded properly. Case A, invoice not received yet, but payment is needed now. Case B, no invoice and no receipt will exist. Internal evidence is needed. It is an internal document. There is no standard design. Checks are less common today, but the control principle remains essential. In Lesson 2.1, the book gives you a practical example showing how a check requisition form is used as an internal control when a payment must be made before the normal paperwork, like an invoice, is available. Think of it as permission plus proof written down before money leaves the business. What is happening in the example? The situation, in simple words, a manager at ABC wants to place an advertisement in a local weekly newspaper. The newspaper requires payment in advance. At this moment, ABC does not have the normal supplier document, an invoice, in hand. ABC still needs to pay, but it must do so safely and with control. So, the business uses a check requisition form to record why the payment is needed, show the amount, attach the available evidence, and get proper approval before a check is drawn. The amount in the example, what each part means. The total payment requested is $470, currency as used in your text. That total is made of two parts. Part 1, the basic cost, before tax, $400. Part 2, sales tax, at 17.5%. Sales tax is calculated as 400 times 17.5%. That equals 70. Total to be paid, 400 plus 70 equals 470. This is the key learning point. When you see plus sales tax, you must add the tax to the base amount to get the check amount. Why the check requisition form is acceptable evidence here. Normally, the best evidence is a supplier invoice. But Lesson 2 explains that sometimes the invoice has not yet been received, or there is no invoice or receipt for that type of payment. In this example, the business still has something to support the payment request. For example, an email or written request confirming the advert and the price. So the form becomes the control document that ties everything together. Below is what each line on the form is doing and why it matters. Date. This shows when the request was raised. The form in the example shows a date in the style 17 January 20x7. Control purpose proves the request is current and supports audit trail. Please draw a check on the company's account. This is the instruction. Create a check using company funds. Control purpose. The payment is not casual. It is formally requested. Payable to. The supplier's name goes here, the newspaper. Control purpose stops the check being made out to the wrong party. Amount. The total check amount goes here, 470. Control purpose prevents guessing the payment amount. Reason. A clear explanation is written, for example, advertising cost and which edition or date it relates to. Control purpose answers the question, why are we paying before the payment happens? General ledger code, if known. This is the account that the payment should be charged to, for example, an advertising or marketing expense code. Control purpose helps the accounts department record it correctly and consistently. Evidence tick boxes. Wording varies by form. Common options shown in your example include ideas such as invoice or receipt to follow, no invoice or receipt, other evidence attached. Control purpose makes the evidence status explicit and forces the preparer to admit what documentation exists right now. Send check to. This states where the check should go, the supplier address or contact. Control purpose reduces the risk of checks being misdirected or intercepted. Signature, department, and contact details. The requester signs and identifies themselves and their department, and usually a phone extension. Control purpose creates responsibility, allows follow-up questions, and supports segregation of duties. Requester is visible, not anonymous. The controls the example is teaching you, the real exam value. This example links directly back to the chapter's payment controls. 1. Documentary evidence. Even if an invoice is missing, you must have some written support. The form collects and references that support. 2. Authorization. A payment must be approved by someone with authority. The form is routed to an authorized person before the check is produced. 3. Restricting who can actually make the payment. Even if a manager requests it, not everyone can draw and sign checks. The process limits check preparation and signing to specific authorized people. How to solve similar exam questions, a simple method you can repeat. When the exam gives you a short story like this, do the following. Step 1. Decide what document is needed. Ask, do we have an invoice now? If yes, you use the invoice for evidence. If no, and payment must be made now, you use a check requisition form. Step 2. Calculate the check amount correctly. Ask, is tax mentioned? If the cost is given plus sales tax, calculate tax and add it. Use the method, base amount times tax rate equals tax. Base amount plus tax equals total payment. Step 3. Complete the form with control-focused details. Always include payee, amount, reason, ledger code if given or logically implied, evidence status, invoice to follow or other evidence attached, and signature details. Step 4. Explain the control purpose if asked why. Use short control phrases, prevents unauthorized payments, creates audit trail, ensures correct ledger posting, reduces fraud risk. Lesson 3. Expenses claim forms. Chapter 8. Authorizing and making payments. What an expenses claim form is. An expenses claim form is used when an employee pays for a business cost using their own money first and then asks the business to pay them back, reimburse them. So the payment flow is, employee pays, out of their own pocket, employee proves it was a real business cost, manager approves it, accounts department reimburses the employee. This matters because if a company reimburses people without strong checks, money can be lost through mistakes, wrong amount, duplicate claims, fraud, fake receipts, personal items claimed as business, poor recording, posted to the wrong account. What kinds of costs are claimed on an expenses form? The book's list. The book gives common examples of expenses employees might pay personally and then claim back. 1. Money spent by the employee on business travel. Think bus or train tickets, taxi fares, flights, hotel costs, parking, and other travel costs that are clearly for work. 2. The cost of newspapers or magazines bought for business use. Example, a newspaper bought because the job requires market news, or a trade magazine needed for work. 3. Part or all of the employee's domestic telephone bill. This only makes sense if the employee uses their personal phone for work calls. The key control point, only the business portion should be claimed, not personal calls. 4. Petrol. Example, fuel bought for business travel, especially where the employee used a personal vehicle for business or fuel for a company vehicle, depending on policy. 5. Car service and repair bills for company cars. Example, the employee paid for a service or repair and is now claiming reimbursement. Again, it must be for a company car and for a business reason. Itemized means list everything clearly. The book states that expenses paid by an employee that they want reimbursed should be itemized on the form. Itemized means you do not write one total only. You list each cost separately, usually with date, what it was for, where it was purchased, amount, and, if relevant, sales tax or VAT. This makes checking and recording much easier. Proof is required, receipts, bills, invoices. The book is very clear. The business should be given proof of the existence of the expense, it actually happened, and the amount of the expense, the number is correct. Usually that proof is a receipt or sometimes a bill or invoice. If there is insufficient supporting evidence, the company may refuse to reimburse the expense. That is a key internal control. No evidence, no payment. The process, the book's steps 1 to 4, explains slowly and clearly. Step 1. Approval and authorization before accounts pays. What happens? The employee, the claimant, completes the form and signs it. Then it is sent to a manager or supervisor, often the employee's superior, for approval and authorization. Only after that does it go to the accounts department. Why this step exists? The manager is acting as a control gate. They check things like, is this expense really for business? Does it fit company rules and policy? Is it reasonable, not excessive? Does it stay within any limits that have been set? This is how the business prevents paying for personal spending or incorrect claims. Step 2. Attach the supporting documents. What happens? Receipts, bills, and invoices should be attached to the form. Why this step exists? This prevents paying a claim with no evidence, paying the wrong amount, duplicate claiming, claiming the same receipt twice. A practical habit is to staple or securely attach receipts and to mark them as claimed once processed. Step 3. Enter the general ledger codes. What happens? After the form reaches accounts for payment processing, the general ledger codes are entered on the form. Sometimes forms already have codes pre-printed. What general ledger code means, simple meaning, it is the label that tells the accounting system which account to post the cost to, such as travel expense, telephone expense, motor expenses, repairs and maintenance, and possibly a department code, cost center, like sales, production, head office. Why this step exists? Without correct codes, travel might accidentally be posted as repairs, telephone might be posted as advertising, totals per department become unreliable, and the financial statements become less accurate. Step 4. Separate the net amount and the sales tax element. What happens? The claim may be split into the net amount, the cost before tax, and the sales tax element, the tax part. The book notes this separation might be done by the accounts department, although sometimes the employee may do it on the form. Why this step exists? Because in many accounting systems, tax is recorded separately. For example, if the business can reclaim input tax, then the net goes to the expense account. The tax goes to a tax control account. This keeps tax reporting and expense reporting correct. How this links to exam-style thinking. How to answer questions. When you see expenses claim form in an exam, train yourself to do this checklist. 1. Identify the situation. Employee paid personally and wants reimbursement. 2. State the key controls, often examinable. Approval by a supervisor before payment, authorization. Receipts attached as evidence, documentation. Accounts enters general ledger codes, accurate posting. Separate net and tax, correct tax and expense recording. 3. If asked about accounting entries, the logic is usually record the expense net as a debit. Record input tax as a debit, if applicable in the scenario. Record the amount owed to the employee as a credit until paid, or credit bank if it is paid immediately. 4. If asked to spot weaknesses, look for no receipts or missing evidence, no manager approval, same person claiming and approving, no tax separation where tax matters, no clear policy or limits. Lesson 4. The timing and methods of payments. Lesson 4 is about one big idea. A business must control when it pays money and how it pays money. Why does this matter so much? Because payments are one of the biggest areas where businesses can get into trouble. Cash trouble. If you pay too early, you may not have enough money left to run the business. Supplier trouble. If you pay too late, suppliers may stop supplying you or chase you aggressively or refuse future credit. Fraud and mistakes. If payment timing is not controlled, the wrong invoice can be paid, the same invoice can be paid twice, or money can be stolen. The book then makes a very practical point. A business uses many different methods to make payments. But if we ignore payroll, wages and salaries, and we ignore petty cash, then the most common and most convenient methods are usually check and automated transfer, a bank transfer done electronically. So Lesson 4 prepares you for real life and exam situations where you must explain what payment timing means, what credit terms mean, and why businesses do not just pay everything immediately. 4.1. When should payments be made and who to? This part is focused mainly on paying suppliers. A supplier sends an invoice to the business, the customer. That invoice tells the business what was supplied, how much is owed, and when payment is due. The key phrase, period of credit. The book says suppliers usually grant a period of credit. A period of credit means the supplier lets the business buy now and pay later. So instead of paying on the same day, the business gets time. That time is part of the supplier relationship and part of cash control. Important meaning of customer in this paragraph. In this lesson, when the book says customer, it means the business that received the goods or service and now owes money to the supplier. So the customer is not a shopper in a store. The customer is the buying business. 4.1, Part A, net 30 days. The book says net 30 days on an invoice means payment is due 30 days from the date of the invoice. Let's make that very simple. The invoice has a date printed on it. You start counting from that date. After 30 days, payment is due. A clear exam-style way to say it is due date equals invoice date plus 30 days. A simple example, invoice date is the first day of March. Terms are net 30 days. Due date equals first day of March plus 30 days. Payment is due around the end of March, depending on the number of days in that month. Exam warning. In the exam, do not guess. If they give calendar dates, count carefully. 4.1 Part B, net 60 days and net 90 days. The book says the same logic applies. Net 60 days means payment is due 60 days from the invoice date. Net 90 days means payment is due 90 days from the invoice date. So your method never changes. Due date equals invoice date plus the credit period. What changes is only the length of the credit period. Why the exam tests this? Because it checks whether you understand that these terms are about timing of payment, not discounts or interest, unless the question clearly says so. 4.1, Part C, a specific payment due by date. Sometimes an invoice does not say net 30 days at all. Instead, it may say something like payment due by, followed by a specific date. In that case, you do not calculate from the invoice date. You use the specific due date printed on the invoice. This is a common real-world practice, and it is very exam-friendly. If the invoice gives a direct due date, that date is the deadline. 4.1 Part D. What happens if payment is late? The book explains. If the invoice is not paid by the specified date, then the invoice becomes overdue. The supplier may send reminders, and the supplier may make telephone calls to chase payment. What overdue means in one sentence. Overdue means the due date has passed and the invoice is still unpaid. Why this is important and a common exam point. Overdue invoices can lead to damaged supplier trust, refusal of future credit, supply stoppages, and increased pressure on the accounts department. So paying on time is not just being nice. It protects the business's ability to operate. Exam method for Lesson 4 and 4.1. When you see a payment timing question, do this. Step 1. Identify the timing rule. Look for one of these. Net 30 days, net 60 days, net 90 days. Payment due by a specific date. Step 2. Apply the correct approach. If it is net days, then due date equals invoice date plus that number of days. If it is payment due by, then use the printed due date. Step 3. State what happens if unpaid. Say clearly, if not paid by the due date, the invoice becomes overdue and reminders may be received. Section 4.1.1 explains who decides which invoices get paid and when they get paid. In real businesses, this decision matters because it affects cash flow, supplier relationships, and control over mistakes and fraud. A senior person in the company makes the decision about who should be paid and when they should be paid. The book says it may be the chief accountant. The important idea is not the exact job title. The important idea is that the person must be senior enough to understand the whole business situation and must have the authority to set payment priorities. A senior person is needed because payment decisions involve judgment. The business must balance more than one objective at the same time. The first objective is cash flow control. If the business pays too many invoices too early, the bank balance can fall too low. Then the business may not have enough money for essential costs, such as wages, rent, utilities, and other urgent payments. The second objective is supplier relationship control. Suppliers expect payment according to agreed credit terms. If suppliers are paid late, suppliers may become strict and may refuse future credit. Some suppliers may stop deliveries until overdue balances are cleared. The third objective is accuracy and fraud prevention. If the business pays the wrong invoice, pays twice, or pays an invoice that is in dispute, money can be lost. Senior oversight reduces these risks. To help the senior person make good decisions, an accounts clerk may be required to draw up a list of unpaid invoices. This list is a planning tool and a control tool. It shows what invoices are unpaid and helps ensure that invoices are not forgotten, misplaced, or ignored. A good unpaid invoice list normally includes details such as supplier name, invoice date, invoice reference, amount due, and due date or credit terms. These details help the senior person decide what should be paid first and what should be checked before payment. The book explains that unpaid invoices may be listed in groups. Grouping the unpaid invoices makes priority decisions easier and clearer. The first group is overdue invoices. Overdue means the due date has passed and the invoice is still unpaid. Overdue invoices are high risk because suppliers may chase payment. Chasing often involves reminders and telephone calls. Overdue invoices can damage trust. Overdue invoices can lead suppliers to reduce credit terms or demand payment on delivery. In serious cases, suppliers may stop supplying until the overdue balance is paid. Because of these risks, overdue invoices often become high priority. However, being overdue does not automatically mean the invoice should be paid immediately without checks. The business should still confirm that the invoice is valid, has not already been paid, and is not under dispute. The second group is invoices outstanding for longer than a certain period of time, such as 2 months. Outstanding means unpaid. This group focuses on the age of the invoice, not only the due date. An invoice that has been unpaid for a long time often signals a problem. It might mean the invoice was lost or filed incorrectly. It might mean approval was delayed. It might mean there is a dispute that nobody followed up. It might also mean the business had cash flow pressure and kept delaying payment. This category forces the business to investigate and resolve old items. The senior person may decide to approve payment if the invoice is valid, or the senior person may ask for investigation if information is missing, or the senior person may require the department to resolve the dispute before payment is made. The third group is invoices soon due to be paid. These invoices are not overdue yet, but they are approaching their due dates. This group supports good planning. Paying on time prevents invoices from becoming overdue and protects supplier relationships. Many businesses use a planned payment run, meaning they pay batches of invoices at set times, such as weekly or monthly. A payment run improves control because invoices can be reviewed together, authorization can be organized, and cash requirements can be planned. The book also compares trade bills and miscellaneous payments. Trade bills are invoices from trade suppliers, meaning suppliers that provide goods and services the business regularly buys for operations. Many businesses tend to pay trade bills at the end of the month. This is common because the business may collect and review supplier invoices through the month and then process payments in a batch at month end. Miscellaneous payments are payments that are not regular trade supplier invoices. These may be paid at various dates during the month as they fall due. The idea is that different types of liabilities are managed differently depending on timing and business practice. In an exam, if you are asked who decides when invoices are paid, you should state that a senior person decides, such as the chief accountant. You should explain that an accounts clerk may prepare a list of unpaid invoices. You should explain that the list may be grouped into overdue, long outstanding, such as 2 months and soon due. You should mention why these categories help, including supplier chasing, credit risk, and planning to avoid overdue invoices. You should also mention that trade bills are often paid at the end of the month, while miscellaneous payments are paid as they fall due. Section 4.2 explains the main methods a business uses to make payments. This section matters because the payment method affects control, speed, cost, and the quality of evidence in the accounting records. A strong business does not choose a payment method only because it is convenient. It chooses a method that keeps payments safe, authorized, and easy to record and check later. The book begins by saying that methods used to make payments are broadly similar to methods used to receive payments. That means banks and businesses use many of the same channels in both directions. Money can move by cash, check, or bank transfer. However, for payments made by businesses, some methods are used far more often than others. The book then states that the most commonly used payment methods are checks, automated transfers such as BACs, especially for wages and salaries, and internet payments. After that, the book lists other methods that are used in some situations, such as cash, banker's drafts, standing orders, direct debits, company credit cards and charge cards, and mail transfer and telegraphic transfer. Wages and salaries are dealt with elsewhere in the text, but the method is mentioned here because it is a major use of electronic payments. Now I will explain each method carefully and show why it is used, what the main control risk is, and what controls a business should apply. This is exactly how you should think in an exam. Define the method in simple words, then link it to control. Checks are a traditional method of payment. A check is a written instruction from the business to its bank, telling the bank to pay a specific amount to a named payee. In a business, checks are useful because they create a clear trail. The payee name is written on the check. The check number can be recorded in the accounts. The check stub or check counterfoil gives a reference. When the check clears, it appears on the bank statement. This makes checks relatively easy to trace and reconcile. The main risk with checks is control over who can write them, who can sign them, and how the checkbook is stored. If checks are not controlled, they can be stolen, forged, altered, or written for non-business purposes. Strong controls include keeping checkbooks locked away, limiting access to check stationery, requiring authorized signatures, and ensuring checks are only signed after supporting documents have been checked and approved. Automated transfers, such as BACs, are electronic payments from the business bank account to another bank account. The business does not hand over paper like a check. Instead, the payment is processed through the banking system electronically. The book highlights BS especially for wages and salaries. That is because wages and salaries often involve many payments to many employees. Automated transfer systems handle this efficiently and safely. The major control risk with automated transfers is that money can be sent very quickly, so mistakes can cause immediate loss. For example, if the wrong bank account number is used, the money may go to the wrong person. Also, if one person has too much access, they could create a false payee or change bank details. Strong controls include restricting who can set up payees, restricting who can change bank details, requiring approval before the payment is released, using dual authorization where two people must approve, and keeping secure records of the payment instruction. In exam language, you should say that automated transfers require strong access controls and authorization controls. Internet payments are payments made using online banking. In practice, internet payments can be used to make one-off transfers, regular transfers, and sometimes bulk payments. They are popular because they are fast and convenient. They also produce an electronic record, which helps reconciliation. The main control risk is that online banking access can be misused. If passwords are weak, if devices are not secure, or if authorization rules are not enforced, a dishonest person could send money out easily. Strong controls include secure logins, limited user permissions, approval limits, two-factor checks where available, and a separation between creating a payment and releasing a payment. In a good business, the person who enters the payment is not the only person who can release it. Cash payments are payments made using notes and coins. Cash can be useful for very small payments, especially in situations where electronic payment is not practical. However, cash has a very high control risk. Cash is easy to steal, easy to lose, and hard to trace. Cash payments often have weaker evidence than bank payments unless receipts are collected and controlled. Because of this, many businesses restrict cash payments to controlled systems like petty cash, with vouchers, receipts, limits, and reconciliations. Even though petty cash is dealt with elsewhere, the control thinking still applies. Cash should be limited, documented, and checked. A banker's draft is a payment instrument issued by a bank. The bank prepares it and the bank guarantees it. Businesses may use a banker's draft when the payee requires more certainty than an ordinary check, or where a secure guaranteed method is requested. The main control point is that bankers' drafts should still be supported by documentary evidence and proper authorization, because they still represent money leaving the business. They should also be recorded clearly because they may not look exactly like a normal check on internal records. A standing order is a regular payment instruction set up by the payer. This means the business tells its bank to pay a fixed amount to a named payee at regular times, such as monthly. Standing orders are common for payments like rent or other fixed regular amounts. The key feature is that the amount is usually fixed. The main control risk is that standing orders can continue even when they should stop, or the amount might be set incorrectly. Strong controls include authorization to set up the standing order, review of standing orders periodically, and cancellation when agreements end. A direct debit is different. With a direct debit, the payee collects money from the payer's bank account under an agreed instruction. Direct debits are often used for bills that can vary, such as utilities. The key feature is that the payee initiates collection. The control risk is that the payee could collect the wrong amount or collect at the wrong time. Strong controls include authorizing the direct debit instruction, reviewing bank statements to check collections, and investigating any unusual amounts promptly. A simple memory rule is, standing order is you send, direct debit is they collect. Company credit cards and charge cards are used for business purchases. They can be very convenient for travel, online purchases, and expenses where suppliers prefer card payment. The main control risk is personal spending being disguised as business spending or spending beyond policy. Strong controls include spending limits, clear rules about what can be purchased, requiring receipts, requiring approval of claims, and regular review of card statements by a supervisor who is independent of the cardholder. Mail transfer and telegraphic transfer are terms used for certain bank transfer methods, often linked to transferring funds across distance or with speed. In modern language, telegraphic transfer is often associated with wire transfer style payments, especially for international transfers. The key exam point is not the technical banking detail. The key exam point is that these are bank-based transfer methods used when location, speed, or formality matters. The controls remain the same: strong authorization, correct payee details, secure banking procedures, and clear recording. Now I will explain how to handle Section 4.2 in an exam. First, if the question asks you to list methods, start with the most common methods the book states. You write checks, automated transfers such as BHS, and internet payments. Then you add the other methods: cash, banker's draft, standing order, direct debit, company card, mail transfer, and telegraphic transfer. Second, if the question asks you to compare methods, compare them by speed, security, and evidence. Checks are slower but provide clear paper evidence. Automated transfers are fast and efficient but require strong access control. Cash is risky and hard to trace, so it should be limited and controlled. Standing orders and direct debits are useful for regular payments but must be reviewed and monitored. Third, if the question asks about controls, link every method to control points: authorization, restricted access, supporting documentation, and bank statement checking. The most important learning from Section 4.2 is this: payment methods are not only about convenience, they are part of internal control. A good business chooses methods that create evidence, reduce risk, and allow easy checking and recording later. In this lesson, the book is teaching you a simple idea. Cash is sometimes necessary in a business, but it is the riskiest way to pay, so it must be used only in limited situations and controlled very carefully. Below is a full, read-aloud friendly explanation of every point shown in Lesson 5, with extra detail so beginner students fully understand it. Cash payments, what they are. A cash payment means the business pays using physical money, like notes and coins, instead of paying through the bank. For example, paying with notes from the cash tin, or giving cash to a supplier, or paying a worker cash. The book explains that businesses use cash mainly for two reasons. First use, small payments out of petty cash. Most businesses keep a small amount of cash called petty cash. This is used for small, urgent items where it is not practical to write a check or make a bank transfer. Examples: buying small stationery items like pens, paper, or staples, paying for minor delivery charges, small staff refreshments for a meeting, a small emergency taxi fare for business purposes. The key point is, petty cash is meant for small payments only. Second use, sometimes wages payments. The book also notes that sometimes cash is used for wages payments. In many modern businesses, wages are paid through the bank, but cash wages can still happen in some situations. Important teaching point for students. Even if wages are paid in cash, the business still needs payroll controls, records, and approvals. Cash wages without records are high risk and can lead to fraud and tax problems. Using cash to pay large amounts should be very rare. The book clearly warns that paying suppliers large amounts of cash should be very rare. Why? Because large cash payments increase the chance of theft, fraud, and missing paperwork. Also, large cash payments can create suspicion and may fall under rules related to money laundering controls. Now, the book lists the main problems with cash payments. I will explain each one clearly. Problem 1. Cash must be kept secure because it is easily stolen. Cash is attractive to thieves because it is easy to take and hard to trace. If someone steals cash, you usually cannot recover it. What kept secure means in practice, keep cash in a locked safe or locked cash box. Limit who has access to the keys. Do not leave cash unattended at desks or tills. Count cash regularly and record the count. Separate duties so the person holding the cash is not the same person who approves spending. Exam point. If the exam asks, why is cash risky? The first answer is almost always, cash is easily stolen. Problem 2. Cash can get lost in the post. If a business sends cash through the mail, it can be lost or stolen during delivery. Also, even if it arrives, there may be no strong proof it was delivered. Practical guidance. Businesses should avoid sending cash in the post. They should use bank transfer, check, or other traceable methods. Exam point. This is a strong control point. Examiners like it because it shows you understand traceability. Problem 3. It is difficult to keep control over cash if it is used often for making payments. When cash is used frequently, it becomes harder to track exactly where the money went. Why control becomes difficult? Many small payments happen quickly. People may forget to collect receipts. Vouchers may not be completed properly. Cash can be taken temporarily and not returned. It becomes easier to hide theft inside many small payments. What strong control looks like? Use a petty cash voucher for every payment. Number vouchers in order, so missing numbers are obvious. Require receipts for every payment where a receipt is possible. Set spending limits, for example, a limit per payment and a limit per day. Reconcile petty cash at regular times, for example, weekly. Do surprise cash counts occasionally. Exam point. If you see petty cash, think immediately about control procedures. Voucher, receipt, approval, reconciliation, and surprise counts. Problem 4. Unless a supplier issues a receipt, there will be no evidence that a cash payment has been made. This is one of the biggest problems with cash. If there is no receipt, it is difficult to prove the payment happened. Why evidence matters? To prove the expense is real, to prevent employees claiming fake expenses, to support accounting records, to support tax records, to prevent disputes with suppliers. So what should the business do? Require a receipt whenever possible. If a receipt is not possible, require another form of evidence, such as a signed acknowledgement or an approved petty cash voucher with explanation and authorizer signature. Exam point. The phrase "no evidence" is important. It links directly to internal control and audit trail. The book says this is bad for record keeping. When there is no receipt, record keeping becomes weak. Weak record keeping causes bigger problems later, such as errors in the accounts, wrong expense totals, difficulty preparing financial statements, difficulty proving expenses if questioned, higher chance of fraud going undetected. Additional warning. Large cash payments can be associated with dishonest or underground trading and can trigger money laundering concerns. The book points out that paying large amounts of cash to suppliers can be associated with shady dealing. Even if your business is honest, large cash payments can look suspicious. Practical implication for businesses. Use traceable payment methods for large amounts. Keep strong documentation for all payments. Follow any legal or regulatory requirements about cash transactions. How to teach students to answer exam questions from this lesson. When the exam asks about cash payments, students should do 3 things. Step 1. State when cash is used. Small payments from petty cash, sometimes wages in cash. Step 2. State why large cash payments should be rare, high risk and poor control. Step 3. List the problems and the controls. Problems: easily stolen, can be lost in the post, hard to control if used often. No receipt means no evidence. Bad record keeping can create suspicion and money laundering concerns. Controls to mention for strong answers. Keep cash locked and restrict access. Use petty cash vouchers and require receipts. Set limits for cash spending. Reconcile petty cash regularly and do surprise checks. Use traceable methods for large payments. Simple accounting link for student understanding. When cash is paid out, the business is reducing cash and recording an expense or asset. In double entry language, debit the expense or asset account. Credit cash or petty cash. That is the accounting meaning behind cash payment. This lesson explains how a business uses checks to pay suppliers and other people, and why checks need strong controls. A check is a written instruction from a business to its bank. It tells the bank, pay this person this amount of money from our current account. In the real world, many businesses now use electronic payments more often, but checks still appear in exams and in some organizations, so you must understand the process and the controls. What the book expects you to be able to do in this lesson. The lesson says you should know how to do 3 things. 1. Prepare a check for payment. 2. Deal with lost checks. 3. Stop checks, meaning you tell the bank not to pay a check. I will explain each one in a friendly way. 1. Preparing a check for payment. Preparing a check is not only writing on a piece of paper. It is a controlled process, because a check is a way to take money out of the bank. A good, controlled check process usually follows this logic. First, there is a real reason to pay. This means there is supporting evidence, usually a supplier invoice or another approved document that proves what we are paying for. Second, someone approves the payment. This is the authorization step. It means a responsible person agrees that the goods or services were received, the price is correct, and the payment should be made. Third, the check is written carefully. The payee name must be correct, the amount must be correct, the date must be correct. Many checks also have security features like being crossed, which reduces the risk of cashing it. Fourth, the check is signed by authorized people. The bank will only pay if the check is properly signed. We will explain this fully in section 6.1. Fifth, the check is recorded in the accounting records. The business must update its cash book or bank records so it is clear that a payment has been made. Sixth, the check and evidence are filed safely. This creates an audit trail. Later, if anyone asks, why did we pay this? The business can prove it. Why check security matters. The book highlights an important control issue. Checkbooks must be kept safe. Why? Because if a checkbook is stolen, a criminal may try to write checks and take money fraudulently. So, businesses usually keep checkbooks under lock and key. For example, in a safe or at least in a locked drawer. Only trusted staff should have access. Also, the person responsible for checkbooks is often also responsible for ordering new checkbooks when old ones run out. That prevents random staff from requesting checks without control. 2. Dealing with lost checks. A lost check is a common practical problem. A check can be lost in the post, it can be delivered to the wrong place, it can be stolen. When a check is lost, the business has 2 big risks. Risk 1, the supplier is not paid, so the supplier complains and the account becomes overdue. Risk 2, the lost check might be found by someone else and used fraudulently. A sensible approach is, first, check whether the check has cleared the bank. If it has cleared, it is no longer lost, it has been paid. Second, if it has not cleared and enough time has passed, contact the supplier and confirm they did not receive it. Third, if you believe the check is genuinely missing, the business should ask the bank to stop the check. This prevents the check being paid if someone finds it. Fourth, issue a replacement check only after the stop instruction is in place and keep a clear record of what happened. In exam answers, always show you understand that a replacement check must not be issued casually. It must be controlled, otherwise the supplier could receive both checks and cash both. 3. Stopping checks. Stopping a check means giving instructions to the bank. Do not pay this check if it is presented. A check may need to be stopped for reasons like, the check was lost. The check amount was written incorrectly. The check was made out to the wrong person. There is a serious dispute about the invoice, and the payment should not proceed. Stopping a check is a control action. It should be documented. The business should keep a note of the check number, the date, the payee, the amount, and the reason for stopping it. 6.1. Signatures on business checks. This is a very important control area. The bank will not allow a check payment from the business account unless the check is properly signed. That means a business must decide who is allowed to sign checks. Those people are called authorized signatories. How the bank knows who is allowed to sign. The business gives the bank a formal record of authorized signatories. This is often called a bank mandate. It contains the names of the people allowed to sign and their specimen signatures. So the bank checks the signature on the check against the signatures it has on record. Why some checks require 2 signatures? Many organizations require 2 authorized signatures for checks above a certain value. This is a strong internal control because it reduces the chance of fraud. It reduces the chance of paying the wrong amount. It forces a second person to review the payment. In exam language, this is part of segregation of duties and authorization control. Who is normally an authorized signatory? The book indicates these are usually senior people, for example, directors, the chief accountant, or a financial controller. The reason is simple. Signing checks is powerful. It moves money out of the bank. Lesson 6.2 is called Procedures for Preparing Checks. The whole purpose is simple. When a business pays suppliers by check, it must pay the right supplier for the right reason, for the right amount, at the right time, and it must leave a clear trail of evidence so nobody can steal money or hide mistakes. Think of Lesson 6.2 as a safe check payment workflow. It is not just paperwork. It is a set of controls that protects the business. The big idea behind Lesson 6.2, when a business pays by check, there are several risks. 1. Paying an invoice that should not be paid yet or was never approved. 2. Paying the wrong supplier or paying the same invoice twice. 3. Writing a check when there is not enough money in the bank, so the check bounces. 4. A check gets lost or stolen and someone tries to cash it. 5. The accounts team records the payment incorrectly later because the paperwork was incomplete. So the book gives a clear sequence of steps. You should imagine these steps as a checklist. The accounts department follows every time they prepare checks. Step 1. Prepare a list of payments that are due. What happens in this step? The accounts clerk prepares a list of all payments that are due. This list usually comes from the unpaid invoices records and the agreed payment timing, such as the supplier's credit terms. Why it matters. If you do not first create a full list, payments become random and disorganized. A disorganized payment process causes late payments, missed invoices, and duplicate payments. The list is also the starting evidence that proves these are the invoices we intend to pay. What students must understand. This is not the step where money leaves the bank. This is the planning step. It answers 2 questions. Who do we owe? And which invoices are due now? Exam technique. If an exam asks, what is the first action in preparing checks? The answer is not write the check. The answer is prepare a list of payments due, because control always starts with planning and checking. Step 2. Make sure the payments are authorized and that sufficient funds are available. What happens in this step? A company should not write and send checks unless it can cover the payments from its bank account, or it has an overdraft facility that allows it to go below 0 up to an agreed limit. So after the list is prepared, a senior person in the accounts department or another responsible manager reviews it and decides which payments will actually be made now. Why it matters. This step prevents 2 major problems. First problem is cash shortage. If you send checks without enough funds, the check may be refused by the bank. That damages the business reputation and can lead to extra charges. Second problem is unauthorized payments. If one employee can decide and pay without approval, fraud becomes easy. This step creates accountability because a responsible person approves the payment plan. What students must understand. This step is about control and timing. The business is choosing when to pay and which invoices to pay based on due dates and available money. Exam technique. In exam questions, words like authorized, approved, senior person, and sufficient funds are key control phrases. Use them because they show you understand internal control. Step 3. Check the invoices that are going to be paid. What happens in this step? The accounts clerk finds each invoice from the list inside the unpaid invoices file and checks important details before any check is prepared. There are 3 main checks in this step. First check. The invoice has been properly authorized for payment, meaning someone responsible confirmed the invoice is valid. The goods or services were received. The price looks correct. The supplier is correct. The invoice is approved. Second check. The general ledger code is on the invoice, meaning the invoice must be coded to the correct account, such as rent expense, repairs expense, motor expenses, or purchases. If the code is missing, the clerk adds the correct code now, so the later accounting entry is not delayed or done incorrectly. Third check. Any remittance advice is kept with the invoice, meaning if there is a remittance advice document related to that supplier payment, it stays attached so the paperwork stays complete. Why it matters. This step prevents incorrect payments. If an invoice is not authorized, it might be fake, duplicated, or disputed. If the ledger code is missing, the payment may later be recorded to the wrong account, which makes financial reports unreliable. If supporting paperwork is missing, the business cannot prove what it paid and why, which is dangerous during audits and during supplier disputes. Exam technique. When you see a question like, what checks should be made before preparing a check, you list these checks clearly. Authorization check, coding check, documentation check. Step 4. Prepare the checks and record the details on the counterfoil. What happens in this step? The accounts clerk uses the invoice information to write the check. At the same time, the clerk records the check details in the checkbook record, often called the counterfoil. Typical details recorded include the name of the person or organization who will receive the check, meaning the payee, the amount, the date, any other helpful reference details such as the invoice number. Why it matters. This step creates a paper trail. Even before the payment is recorded in the ledger, the business has an internal record showing which check was written, to whom, and for what. Important control explained in this step. Crossing the check and using account payee. Modern business checks are often pre-printed with 2 lines across the check and the words account payee between the lines. This matters because it means the check should only be paid into a bank account belonging to the named payee. It cannot easily be cashed by anyone who finds it. This reduces the risk of theft. Exam technique. If the exam asks, how do cross checks improve security? You explain that crossing an account payee reduces the chance that a lost or stolen check can be turned into cash by a thief. Step 5. Attach the invoice and remittance advice to the check and send it for signature. What happens in this step? The check is attached to the invoice and any remittance advice. Then it is submitted to the authorized person or authorized persons for signature. Why it matters. This step links the payment instrument, which is the check, to the reason for payment, which is the invoice. It also enforces separation of duties. One person prepares the check, another person approves by signing. That makes fraud harder. What students must understand, a signature is not decoration. It is a control. The signer is saying, I approve this payment. Exam technique. In written answers, you should use the phrase authorized signatures. And also mention that the invoice is attached to prove the payment is valid. Step 6. Mark the invoice as paid and record key payment references. What happens in this step? Once the check is signed, the invoice should be stamped paid. The date of payment should be written near the stamp. Ideally, the check number should also be written on the invoice. Why it matters. This step prevents duplicate payment. If the invoice stays in the unpaid invoices file with no clear paid mark, another clerk might pay it again next week. Stamping paid, adding the date, and adding the check number creates strong evidence that the invoice has already been settled. The example idea in the book. The book shows a check for $1,520.75 made payable to a supplier, prepared on a date in the year 20x7 and linked to an invoice number written as 12345. It also highlights a common control rule. Checks over $1,000 may require 2 authorized signatures. Why 2 signatures can be required? Because higher value payments carry higher risk. Requiring 2 people reduces the chance that one person can steal money by themselves. Exam technique. If an exam asks how do organizations prevent duplicate payments, the best answer includes this step. Stamp paid, add date, add check number, and move the invoice out of the unpaid file. Step 7. Send the check to the payee with remittance advice or a covering letter. What happens in this step? The check is posted or delivered to the supplier. It should normally go with a remittance advice. The remittance advice tells the supplier what the payment is for, such as which invoice numbers are included. If there is no remittance advice, then the business should send a covering letter explaining the purpose of the check, so the supplier can allocate the payment correctly. Why it matters. Suppliers need to match payments to invoices. If they cannot match it, they may think you have not paid, and they will chase you again. Good communication reduces disputes and saves time. Exam technique. If you see the phrase remittance advice in an exam, you explain its purpose clearly. It helps the supplier allocate the payment to the correct invoice or invoices. How to solve Lesson 6.2 style questions in the exam. Most exam questions on this area are not calculations. They are process and controls questions. So you win marks by writing a clear, ordered procedure. A strong exam answer follows the same order as the book. Step 1, list payments due. Step 2, get authorization and check sufficient funds. Step 3, check each invoice is approved, coded, and supported by documents. Step 4, write checks and record details in the check record. Step 5, attach documents and obtain authorized signatures. Step 6, stamp invoice paid and write the date and check number to prevent duplication. Step 7, send the check with remittance advice or a covering letter. If you remember that sequence and explain why each step protects the business, you will score very well. Lesson 6.3, Discounts for Early Settlement, explained in much more detail. In this lesson, we focus on one very important idea. The amount a business pays to a supplier can change depending on when the business pays. If the business pays early, the supplier may allow the business to pay less. That less is called a discount for early settlement. One key definition first. An early settlement discount is a discount a supplier offers to encourage the customer to pay quickly. It is also often called a settlement discount, a prompt payment discount, a discount for early payment. All these phrases mean the same idea. Pay early, pay less. Why suppliers offer this discount? Suppliers offer early settlement discounts because suppliers want cash sooner. Cash sooner helps a supplier to pay wages and salaries, pay their own suppliers, avoid borrowing money from the bank, reduce the risk of late payment, keep cash flow stable. So the supplier is basically saying, if you help me by paying quickly, I will reward you by reducing the amount you owe. What the credit terms usually look like. When a supplier offers an early settlement discount, it is usually written in credit terms. Credit terms tell you how long you have to pay, whether you get a discount for paying early, what happens if you pay late. A typical example looks like this, written in words, 2% discount if paid within 10 days, otherwise net 30 days. This means, if you pay within 10 days, you can reduce the invoice by 2%. If you do not pay within 10 days, you must pay the full amount by 30 days. The book's main point in simple words. The lesson says that the timing of payments may depend on the credit terms offered by suppliers, including discounts for prompt payment. That means timing matters. Paying earlier might save money. Also, if a discount is received, it must be deducted from the payment you make. So you do not pay the full invoice and then wait for a refund. You simply pay the reduced amount. Step-by-step example. In very simple language. Imagine a supplier sends an invoice for $1,000. The terms say, 2% discount if paid within 10 days. Step 1. Calculate the discount. 2% of $1,000 is $20. How did we get $20? 2% means 2 out of every 100. So we take $1,000 and we calculate 2%. That equals $20. Step 2. Calculate the amount you actually pay. Invoice amount is $1,000. Discount is $20. Payment is $1,000 minus $20. Payment equals $980. So if you pay within 10 days, you pay $980. If you pay after 10 days, you pay $1,000. Why this discount changes the accounting entry. In bookkeeping, the supplier is usually recorded in a trade payables account, also called a supplier account. When you receive the invoice, you owe the full invoice amount. So the supplier account shows the full amount due. When you pay early and take a discount, two things happen at the same time. You clear the supplier's balance completely because you no longer owe anything. You pay less cash because the supplier agreed to reduce the amount due. So the difference between the full invoice amount and the cash paid must be recorded somewhere. That somewhere is the discount received account. The logic of the double entry, explained slowly. Using the same example, invoice amount is $1,000, discount is $20, cash paid is $980. Ask yourself, what must be cleared? The supplier balance must be reduced by the full $1,000 because the invoice is settled completely. So the double entry is 1. Debit the supplier account by $1,000. This removes what you owed to the supplier. 2. Credit the bank by $980. This shows the cash leaving the business. 3. Credit discount received by $20. This records the benefit you gained because you paid less than the original invoice. Notice the totals match. On one side, you have $1,000. On the other side, you have $980 plus $20, which equals $1,000. That is why the entry balances. A second example, so students do not get confused. Imagine an invoice of $500. Terms say 5% discount paid within 7 days. Step 1, calculate the discount. 5% of $500 is $25. Step 2, calculate the payment. $500 minus $25 equals $475. Step 3, the bookkeeping idea. Supplier account is cleared by $500. Bank is reduced by $475. Discount received is $25. What students must be careful about? Many beginners make one common mistake. They reduce the supplier account by the cash paid instead of reducing it by the full invoice amount. That is incorrect. You reduce the supplier account by the full invoice amount because the supplier has agreed that the invoice is fully settled. Another beginner mistake is forgetting to calculate the discount correctly. Students sometimes calculate the discount on the wrong number, or they calculate it after tax when the question expects it before tax. In exam questions, always follow the instructions and the way the question presents the figures. If the question gives you one total invoice amount and does not split tax, then calculate the discount on the total. If the question splits the tax and tells you how the discount should be treated, follow that instruction. How to solve similar exam questions, step by step. When you see an exam question mentioning a settlement discount, do this every time. Step 1. Identify the discount terms. Look for words like prompt payment discount, early settlement discount, or settlement discount. Step 2. Check whether the payment qualifies. Compare the payment date with the discount period stated in the terms. Step 3. Calculate the discount amount. Take the invoice amount and calculate the discount percentage. Step 4. Calculate the cash payment. Invoice amount minus discount amount equals cash paid. Step 5. Prepare the double entry logic. Supplier account is cleared by the full invoice amount. Bank is the cash paid. Discount received is the difference. Lesson 6.4. Advantages and disadvantages of paying by check. In Chapter 8, Lesson 6.4, the book is asking you to step back and think like a business, not just like a person writing a check. A business chooses a payment method because it affects 4 things at the same time. First, speed. How fast does the supplier receive the money? Second, control. How well can the business prevent wrong payments and fraud? Third, evidence. How well can the business prove what was paid, to whom, and why? Fourth, cost and convenience. How easy it is to use the method day to day. Checks are used less than before because many businesses now pay electronically, but checks still appear in real life and in exams. So you must understand both sides, why checks can be useful and why checks can cause problems. Part 1. Advantages of paying by check. Advantage 1. Checks are convenient to use for payments of any amount as long as the business has enough money in the bank or it has an arranged overdraft facility. What convenient means here? Convenient means the business can make a payment without needing to carry cash, without needing the supplier to be physically present, and without needing the business to count and handle notes and coins. A check is a written instruction from the business to its bank. It tells the bank to pay a specific person or organization. Why this is an advantage in a real business. In business, payments can be small or large. A business might pay a small supplier invoice, or it might pay a very large invoice for equipment, rent, or professional services. Cash is risky and difficult to control for large payments. A check allows the business to make that payment in a controlled, documented way. The key condition: sufficient funds or an overdraft facility. A check only works properly when the business has money available in its bank account. If there is not enough money, the bank may refuse the payment. That would cause problems like late payment, damaged supplier relationships, and possible fees. Sometimes a business has an arranged overdraft facility. That means the bank has agreed in advance that the business can temporarily go below zero in its bank account up to an agreed limit. In that case, the business can still pay by check even if the account balance is low, as long as it stays within the overdraft limit. A simple example to make it clear. Imagine a business needs to pay a supplier for goods. Paying with cash would mean taking cash out of the bank, carrying it, and then proving later that it was paid. That creates risk. Paying by check allows the business to send a payment safely, and it remains connected to the bank account records. Why this advantage links to good control. Even though checks can have disadvantages, the convenience advantage is that the business can make payments in a structured way. The check can be prepared by the account staff, checked by a senior person, and signed only by authorized people. That creates a controlled payment process. Advantage 2. The check counterfoil and check number provide a useful method for tracing past payments whenever queries arise. What tracing means in business? Tracing means being able to answer questions like these. Did we pay this supplier invoice or not? When did we pay it? How much did we pay? Which check was used? Was the check cashed or is it still outstanding? When a business cannot answer these questions, it wastes time, can pay the same invoice twice, or can argue with suppliers because nobody is sure what happened. What the check number does. Each check has a unique check number. That number becomes an identity for the payment. If someone asks about a payment, the business can use the check number to follow the evidence. What the counterfoil does. Many checkbooks have a counterfoil, which stays in the checkbook after the check is torn out. The counterfoil is like a copy record. It usually contains the key details, such as who the check was paid to, the date, and the amount. So even if the check itself has left the business still has a record of what was written and sent. How tracing actually works in practice. When a supplier calls and says, "You have not paid us," the accounts team can do a clear check. First, they check the supplier account in the payables ledger to see whether the invoice is marked as paid. Second, they check the check number recorded against that payment. Third, they check the check counterfoil to confirm the payee name, date, and amount. Fourth, they check the bank statement and the bank reconciliation. If the check has cleared, it will appear on the bank statement. If it has not cleared, it might be an outstanding check, which will appear in the bank reconciliation. Why this advantage is important for accuracy and preventing mistakes. Tracing reduces errors such as paying the wrong supplier, paying the wrong amount, or paying the same invoice twice. It also helps the business prove what it did, using evidence instead of relying on memory. A simple example to make it very clear. Suppose you paid a supplier by check. 2 weeks later, the supplier says the invoice is still unpaid. If you used a check, you can check the check number and counterfoil, then check whether that check has cleared the bank. If it cleared, you can confidently say the payment was made, and you can provide the check number and date. If it did not clear, you can investigate whether the check was lost in the post or sent to the wrong address, and then take the correct next step. How to use these advantages in an exam answer. If an exam question asks, "State 2 advantages of paying by check," you should write 2 clear points like this, with short explanation. Point 1. Checks are convenient for payments of any amount, as long as the business has sufficient money in the bank or an arranged overdraft facility. Point 2. Check numbers and counterfoils provide a clear audit trail, helping the business trace and prove past payments when questions arise. Now we will discuss the disadvantages of paying by check. A check can work well in a business, but checks also create problems. These problems are the reason many businesses now prefer electronic payment methods. There are two main disadvantages in this lesson. The first disadvantage is security. The second disadvantage is speed and reliability. Disadvantage 1. Security problems, theft and misuse. Forged signatures. A check is a physical document. Because it is physical, it can be stolen, it can be lost, it can be damaged, it can be copied, it can be altered. If a checkbook is stolen, the thief has access to blank checks. A blank check is dangerous. A thief may try to write a check to themselves. A thief may try to write a check to a fake supplier. A thief may try to change the amount written on a check. Checks can also be misused inside the business. This means an employee could abuse the check process. For example, an employee may prepare a check for a payment that is not genuine. For example, an employee may pay a friend. For example, an employee may pay a supplier twice and hide the second payment. This is why check procedures must include checks and authorization. Now we explain forged signatures. A forged signature is a fake signature. It means someone signs a check pretending to be an authorized signatory. If the bank accepts the signature, the bank will pay the check. Then money leaves the business bank account. This can cause a direct loss to the business. So the risk is not only outside thieves, the risk can also be inside the organization. That is why check security must be strong. Checks are only safe when the controls are strong. If controls are weak, checks can be an easy way to steal money. Examples of controls that reduce check security risk. Keep checkbooks locked away. Limit who can access checkbooks. Keep a list of authorized signatories. Require 2 signatures for higher value payments. Never sign a blank check. Only sign checks after checking the invoice and evidence. Separate duties. One person prepares, another person signs. Check bank statements and do bank reconciliation regularly. Even though checks have security risks, the book also notes something important. Checks can be more secure than cash for larger payments. Cash can disappear with almost no trace. Checks usually leave more evidence because they go through the bank. But checks still have major risks if the business does not control them. Disadvantage 2. Checks can be slow. Checks can be less reliable. Suppliers may refuse them. Now we move to the second disadvantage. Checks can be a slow method of payment. Checks can also be less reliable than electronic payments. Why are checks slow? Because there are many steps. First, the accounts department prepares the check. Second, the check must be signed by authorized people. Third, the check must be posted or delivered. Fourth, the supplier must receive it. Fifth, the supplier must take it to the bank. Sixth, the bank must process it. Seventh, the check must clear. Each step takes time. Also, the post can be delayed. A check can be lost in the post. A check can be delivered to the wrong address. A supplier can misplace the check. A supplier can delay banking it, so the supplier may not receive money quickly. This can create supplier frustration. It can lead to reminders and telephone calls. It can damage the business relationship. Now we explain why checks can be less reliable. Reason 1. Timing is uncertain. With a check, you do not control when the supplier banks it, so you do not know exactly when money will leave your bank account. That makes cash planning harder. Reason 2. Insufficient funds can cause failure. If the supplier banks the check when the business bank balance is too low, the bank may refuse the check. This is often called the check bouncing. Then the supplier is not paid. The supplier may charge fees. The bank may charge fees. The business reputation is harmed. Because checks can be slow and uncertain, some suppliers may ask for other methods. The book gives an example of a standing order. A standing order is a bank instruction set up by the payer. It pays a fixed amount on a fixed schedule. For example, rent each month. It is automatic. It is usually prompt. It is usually predictable. So some suppliers may insist on a more prompt and reliable payment method. They may prefer standing orders or electronic transfers. They may refuse checks, especially if they have experienced delays before. How to answer this in the exam? If the exam asks for disadvantages of paying by check, you can write these points. Point 1. Security risk. Checks can be stolen or misused. Checkbooks can be stolen. Signatures can be forged. Strong controls are required. Point 2. Slowness and unreliability. Checks can be delayed in the post. Checks can be lost. Checks take time to clear. Payment timing is uncertain. Checks can bounce if funds are insufficient. Suppliers may prefer prompt and reliable methods, such as standing orders. Lesson 6.5. Lost checks. Students, in this lesson, we focus on a real problem that happens in business. A business writes a check, posts it to a supplier, and later the supplier says, "We have not received your payment." This is called a lost check, but we must be careful. The check might be genuinely lost in the post, or it might have been delivered to the wrong place, or it might already have been paid by the bank and the supplier's records are wrong. The key message of Lesson 6.5 is this: do not immediately write a new check. First, you must investigate in a logical order so you do not pay twice. Why a lost check is difficult. A check is a paper document. It moves physically from your office to the supplier. Then the supplier takes it to the bank. Because of this, there can be a delay and there can also be mistakes. Also, you often do not realize the check is missing until the supplier contacts you. The book explains that the loss may not become apparent until the supplier writes to you or telephones your office demanding payment. In other words, you might think everything is fine, but the supplier's account still shows the invoice as unpaid. This creates several risks. First, the risk of double payment. You send a replacement check, and later the first check is presented and paid as well. Second, the risk of wrong allocation. The supplier receives the check, but the wrong person receives it inside the supplier's organization, so the payment is not matched to your invoice. Third, the risk of fraud or misuse. A check that goes to the wrong address might be opened by someone else. So the purpose of the procedure in this lesson is control, accuracy, and avoiding double payment. The 2 checks you should do before calling it lost. Check 1. Look at the supplier's account in your purchase ledger. The book says you should check the supplier's account in the purchase ledger to see that a payment by check has been made. What does that mean in simple terms? In your accounting records, the supplier has a personal account. When you pay a supplier, you record it there. If you paid by check, you should see an entry such as bank or check payment in that supplier account. This check helps you answer a basic question. Did we actually record a check payment for this supplier for this invoice? If there is no payment recorded, then maybe the check was never prepared, never signed, or never posted. In that case, the problem is inside your business, not in the post. If there is a payment recorded, then you move to the next check. Check 2. Think about when the check was sent. The book says that if a check has been sent to the supplier and the date it was sent is not recent, then the check has probably been lost or misdirected. This is about timing. If you posted the check very recently, it may simply still be in the post. But if you posted it a while ago, it should normally have arrived. So the longer the time has passed, the more likely there is a delivery problem or misdirection. At this stage, you still do not replace the check. You now follow the formal steps. The actions to take when it appears a check has been lost. Step 1. Confirm the check has not gone through your bank account. This is the most important control step. If the check has already gone through your bank account, it means the bank has paid it. That means money has left your account. If you write a new check now, you could pay twice. How do you confirm it has not gone through? The book gives 2 practical methods. First method. Check the most recent bank statements. If the check has been presented and paid, you will see it as a payment in the bank statement. Second method. Telephone the bank. The bank can confirm whether the check number has been presented for payment. When you do this step, you are trying to answer one clear question. Has the bank already paid this check? Yes or no? Only after you know the answer can you decide the correct action. Step 2. Check the details of the name and address used due. If the check has not gone through the bank, the next step is to check where you sent it. The book says you should check the name and address of the supplier to which the check was sent, and the name of any particular person to whom the letter was addressed. Why does this matter? Because a check can be lost simply because it was sent to the wrong address. Or it can arrive at the supplier but go to the wrong person or wrong department. For example, it might be addressed to a person who is on leave, or it might be delivered to a different branch. This step helps you spot mistakes like a wrong street number, a wrong postal code, an old address that the supplier no longer uses, a wrong contact person. After step 1 and step 2, you can usually classify what happened. The book then explains that one of 3 things will probably have happened. One of 3 things probably happened, and what you do in each case. Circumstance 1. The check has gone through your bank account and the supplier has been paid. If the check has been paid by the bank, then the supplier has received the money, even if they say they have not. In this circumstance, the book says the error is in the supplier's records. So your action is not to pay again. Your action is to help the supplier trace the payment. You do that by giving the supplier, in writing or by telephone, the details of the payment, such as the date of the check, your bank name, your branch details, your sort code, the check number, your bank account number. These details allow the supplier to search their bank deposits and internal records and then match the money to your invoice. The accounting mindset here is simple. If money left your bank, you do not send another payment. You prove payment and ask the supplier to correct their records. Circumstance 2. The check has been sent to the supplier, but to the wrong person in the supplier's organization. In this case, the check may be sitting somewhere inside the supplier's business, unopened, misfiled, or waiting on the wrong desk. The book says you should inform the relevant member of staff at the supplier, and they will retrieve the check. What does relevant member of staff mean? It means someone who can actually locate the check and get it processed. For example, the accounts payable team, the cashier's office, or the person who receives mail. Your goal is to get the supplier to find the original check, bank it, and then mark the invoice as paid. Here you still do not replace the check because the original check might be found and paid. Circumstance 3. The check has been sent to the wrong address or it has been lost in the post. This is the true lost check situation. If it appears to be the case, the book says you should take measures to stop the old check and prepare a new one. This is a very important control point. You do not simply write a new check and ignore the old one. You must stop the old check so that if it later appears, it cannot be paid. In practice, stop the old check means you instruct the bank not to honor that check if it is presented. Then you prepare a replacement check and send it using the correct address and correct contact details. From an exam perspective, this is a classic point. Replacement payment is only safe after stop action has been taken on the original check, assuming it has not already been paid. How to answer similar exam questions. Exam questions often use a scenario like this. A supplier says they have not received payment. You paid by check. What steps should you take? A strong exam answer follows the same logic and order as the book. Write it as a clear procedure. First, check your purchase ledger supplier account to confirm a check payment was recorded and identify which invoice the payment relates to. Second, confirm whether the check has been paid by the bank by checking recent bank statements or contacting the bank. Third, check the payee name, supplier address, and the specific person the letter was addressed to identify misdirection errors. Fourth, conclude which circumstance applies. If the check has been paid, provide payment tracing details to the supplier and do not pay again. If it was sent to the supplier but the wrong person received it, contact the supplier so they can retrieve and bank the check. If it was sent to the wrong address or lost in the post, stop the check and then issue a replacement. If you write your exam answer in this sequence, you demonstrate 2 things examiners like. You understand internal control, especially the prevention of double payment. You understand practical business procedures, how a real accounts department would deal with the problem. Lesson 6.6 is about stopping checks. Stopping a check means you tell your bank, do not pay this check if anyone tries to cash it or deposit it. This lesson is important because in real businesses, checks do not always move smoothly from the business to the supplier. A check can be lost, sent to the wrong place, or become out of date. If you do nothing, the business can face 2 problems at the same time. First problem, the supplier says, we did not receive payment, so your business looks unpaid and disorganized. Second problem, the check might still be paid later by the bank, even after you issue a replacement, which means you could pay twice. So, stopping the check is a control step to prevent loss and prevent double payment. Why would a business stop a check? A business may need to stop a check more often than you might think. Many businesses even have a standard form for stopping checks. A check is often stopped because it has been physically lost in transit. That can happen on the way to the supplier or even after the supplier receives it. A check may also need to be stopped if payment has been made to the wrong person, or if the person who received the check forgot to pay it into the bank until it becomes out of date. The book explains that a check becomes out of date after 6 months. In that situation, the bank should not pay it, but the business should still stop the check as a precaution so the bank does not pay it in error. The 2 actions you must take to stop a check. First action, telephone the bank. You telephone your bank and clearly say you want the check to be stopped. When you do this properly, you are giving the bank the information it needs to identify the check and block it, such as the check number, the date on the check, the amount of the check, the name of the payee, meaning who the check is payable to, your bank account details. In practice, you should also write down the name of the bank staff member you spoke to and the time of the call, because this becomes part of your evidence trail inside the business. Second action, confirm in writing. After the phone call, you must confirm the instruction in writing. This written confirmation is critical because it creates clear documentary evidence. It also reduces misunderstandings. Banks receive many phone calls, so the written instruction supports accuracy and accountability. The book mentions that a company may use a form for this. The accounts clerk fills it in, then it is signed by a person who is an authorized signatory for checks. That signature matters because it proves the stop instruction is approved by someone with authority. The example letter to the bank and what each part means. The book shows a sample written instruction to the bank. Even if your business uses a form rather than a letter, the logic is the same. The purpose of the letter. The letter is written to confirm a phone request and to instruct the bank to stop payment of a specific check. The key pieces of information in the letter. The letter includes the business details and the bank details. Then it states the account number, so the bank knows exactly which account the check belongs to. Then it lists the check details. In the example, the letter includes check number 009372, check date 3rd of July 20x7, check amount $4,276.83, payee name A&P Plant. Why does the bank need all these details? Because banks process huge volumes of transactions. If you do not provide enough details, the bank may stop the wrong check or may not stop anything at all. The check has not cleared evidence. The letter says the business has inspected its bank statements up to a certain check number, and the check is not listed. That is the business proving, based on records, that the check has not gone through the bank account yet. In the example, it says the statements were inspected up to check number 493 inclusive. This is an internal control point. It reduces the risk that you try to stop a check that has already been paid. Mentioning a replacement check. The letter also states that a replacement check has been drawn, and it gives the replacement check number. In the example, the replacement check number is 009406. This is included so the business has a clean trail. One check is being blocked, another check is being issued instead, and both are documented. Very important point. Stopping a check does not cancel the debt. If a check is stopped because it was lost, the supplier still has the right to be paid. Stopping the check is not refusing to pay. It is simply preventing the original check from being paid. That is why the lesson immediately explains what to do next. Prepare a replacement check, but do it with strong controls so you do not pay twice. What to do inside the business after stopping the check. The book gives a clear set of internal steps. These steps protect the business and also protect the accuracy of the accounting records. First internal step, get authorization to prepare the replacement check. The authorization should come from a designated person, for example, the chief accountant, who is likely to be the person who signed the form instructing the bank to stop the original check. This matters because preparing a replacement check is a risk area. Without authorization, someone could create extra checks and steal funds. Second internal step, update the supplier invoice evidence. The supplier invoice will usually have been stamped paid with the date and check number. But now the business must also show that the old check was stopped and that a replacement check has been issued. So the invoice record should be altered to indicate the old check has been stopped, the date the old check was stopped, the number of the replacement check. This prevents a very common error. Later, another employee might see paid and assume everything is finished, even though payment was not actually received by the supplier. Third internal step, update the counterfoil of the old check. The counterfoil is your internal record in the checkbook. The counterfoil of the old check should be amended to record the word stopped and the date on which the stop happened. This creates a permanent audit trail inside the checkbook itself. Fourth internal step, complete the counterfoil of the new check properly. The counterfoil of the new check should refer to the supplier invoice and clearly indicate that it is a replacement check. That way, anyone reviewing the records later can connect the new check to the same original invoice, and they will not treat it as a second unrelated payment. Fifth internal step, send the replacement check with supporting documents. The replacement check should be sent to the supplier with supporting documentation, such as a covering letter or remittance advice. This reduces confusion at the supplier's end. It also helps the supplier allocate the payment to the correct invoice. How to handle exam questions on stopping checks. When an exam question is about a lost check or a check that might be paid incorrectly, use this exact thinking process. First, confirm whether the check has cleared. You check the bank statement or recent bank transactions. Second, if it has not cleared, instruct the bank to stop it. You do this by phone, then confirm in writing. Third, remember that stopping the check does not remove the liability to the supplier. So you prepare a replacement check, but only with proper authorization. Fourth, protect the accounting trail. You update the invoice record, you update the old check counterfoil, and you record the replacement check as a replacement, not a new payment for a new expense. Fifth, ensure the supplier receives clear information by sending remittance advice or a covering letter. If you follow that order in the exam, your answer will look professional and complete, and you will not miss the control points the examiner wants. Bank giro credits, also called credit transfers. In the book, this is explained as a way that money can move through the banking system without using a check. It is a method that can be used for receiving money from customers, and it can also be used for making payments to suppliers, although the book clearly says that it is not very common for businesses to pay suppliers this way. What a bank giro credit is, in simple words. A bank giro credit is a payment instruction. It tells a bank, please take this amount of money and transfer it to this supplier's bank account. So instead of writing a company check to the supplier, the business gives the bank a completed giro credit transfer form. The bank then sends the money to the supplier's bank account. This is why the book uses the phrase credit transfer. The supplier's bank account is credited, meaning increased by the amount of the payment. How the payment is actually made in real life. The book describes a practical method. A business can pay a supplier using a bank giro credit by doing these actions. First, the business completes a bank giro credit transfer form. Second, the business takes the form to a bank branch. Third, the business makes the payment at the bank. This might be done using cash or another method accepted at the counter. The book also warns that there might be a fee charged by the bank for providing this service. Then, the bank processes the instruction and transfers the money to the supplier. The important idea is that the bank is acting as the middle person that moves money from the payer to the supplier. Why banks prefer pre-printed giro credit forms. The book explains a very important control and accuracy problem. Banks often find there are problems when bills are paid this way because the information entered on the transfer form is often wrong. This can happen because a person may write the wrong account number, the wrong reference, the wrong amount, or the wrong payee details. If the information is wrong, the payment can be delayed, misallocated, or even sent to the wrong place. That is why banks issue pre-printed forms whenever possible. A pre-printed form already has key information printed on it, such as the supplier's account details and reference fields. This reduces human error. So, the customer or business only needs to fill in a few items, such as the date, the amount, and a signature, depending on the design. This is an internal control idea. The fewer details a person has to write manually, the lower the chance of a mistake. How utility companies use these forms. The book gives a strong real-life example. Most utility companies often use a pre-printed payment strip attached to invoices. Examples include telephone companies, electricity companies, and water companies. Here is the logic. The supplier sends an invoice with the detachable pre-printed paying-in slip. The person paying detaches the slip, fills in the date and the amount, signs if required, and pays it at a bank branch. This is very efficient for utilities because they have large volumes of customers paying similar bills every month. It also helps the supplier allocate the payment correctly because the slip usually includes a customer reference or account reference that matches the supplier's records. Why businesses do not often use bank giro credits to pay suppliers. The book states that, in practice, bank giro credits are rarely used by businesses to pay suppliers. The main reason is convenience. The process often involves going to a bank branch, and as the book notes, bank branches are closing, so this is less convenient than it used to be. Another reason is that businesses now use faster electronic methods, such as online banking transfers, automated transfers, or other systems. Even when the book is discussing bank giro credits, it is teaching you the concept as part of the wider topic of payment methods and controls. When a business might still use bank giro credits. The book gives one clear situation. A business may use bank giro credits when the supplier sends an invoice with a detachable pre-printed bank giro credit transfer paying-in slip. That means the supplier is guiding the customer toward this payment method by providing the slip already prepared with their details. In those cases, the business can simply complete the missing fields and make the payment. The book also mentions another use in practice. Bank giro credit transfers are sometimes used by small companies to pay monthly salaries. The key idea is that instead of writing and posting many checks, the business can instruct the bank to transfer amounts to staff through a credit transfer process. What the payment slip is showing you and why it matters. The book shows an example of a payment slip. You do not need to memorize the exact layout of every slip. Different organizations design them differently. What you do need to understand is what information a slip typically carries and why. A typical slip will contain the supplier's bank details and reference details. These are printed so that the payment reaches the correct organization and is allocated to the correct customer account. A slip may also show an amount to pay. This helps the payer avoid writing the wrong amount. A slip may have a contact phone number. This helps if the payer has a question about the bill. A slip may have spaces for date and signature. This creates evidence and helps control. The overall purpose of the slip is to reduce mistakes, speed up processing, and create a clear audit trail of payment. How to answer exam questions about bank giro credits. In an exam, if you see the phrase bank giro credit or credit transfer, the examiner wants you to show that you understand three things. First, it is a method of transferring money through the bank without issuing a company check to the supplier. Second, it uses documentation, usually a transfer form or a pre-printed paying-in slip, to reduce errors and provide an audit trail. Third, it is commonly seen with utility bills and other regular payments, and the reason pre-printed forms are used is to reduce incorrect information being entered. A strong exam explanation usually includes control language such as these points. Pre-printed details reduce errors. The reference ensures correct allocation. The documentation supports authorization and recording. The system reduces the risk of misposting compared with fully handwritten details. If the exam asks for advantages and disadvantages, you can say the advantage is accuracy and allocation when the slip is pre-printed, and the disadvantage is inconvenience and the risk of errors when details are handwritten, plus possible bank fees. To make it clear, imagine your business receives an electricity invoice. Attached to the invoice is a pre-printed paying-in slip. The slip already contains the electricity company's bank account details and your customer reference. You fill in the date and the amount you are paying. You take it to the bank and pay it. The bank transfers the money to the electricity company. The electricity company receives the money and matches it to your customer reference, so your account is updated and the invoice is treated as paid. That is exactly the situation the book is describing when it lists electricity companies, telephone companies, and water companies as common users of these pre-printed forms. We start Lesson 8, Payments by Banker's Draft, also called a payable order. In simple words, a banker's draft is a payment method where the bank prepares the payment document, not the business. Because the bank issues it, the supplier treats it as much safer than an ordinary business check. What is a banker's draft, and why do businesses use it? A banker's draft is a document issued by a bank that orders payment to a named person or business for a fixed amount. The key idea is this. When a business writes a normal check, the supplier has a risk. The check could bounce if there is not enough money, or it could be stopped. When a business uses a banker's draft, the bank is involved directly, so the payment is guaranteed once the draft is issued. That is why the book highlights a very important rule. A banker's draft cannot be stopped or canceled after it has been issued. So from the supplier's point of view, once they receive it, they can relax. They know they will get paid. When would a supplier ask for a banker's draft? A supplier might ask for this method when 1. The amount is large. 2. The supplier does not know the customer well and does not want credit risk. 3. The supplier wants a guaranteed payment before releasing valuable goods. The example in your page uses a very clear situation. A director wants to buy a car from a dealer, and the cost is $33,334.45. For a large purchase like this, the supplier might refuse a normal check and insist on a banker's draft. Why a banker's draft is different from a normal check. Here is the comparison, in very easy language. A normal business check. The business writes it, the supplier deposits it, the bank checks the business account. If there is not enough money, it can bounce. It might also be stopped by the business in some situations. A banker's draft. The bank prepares it. The bank usually takes the money from the business account before issuing the draft, or makes sure funds are available. Once issued, the bank will pay the supplier. It cannot be stopped or canceled after issue, so it is treated as guaranteed money. Because of that, a banker's draft should be treated like cash inside the business. It must be protected carefully, using the example in your page. Step 1. Prepare an application for a banker's draft. The business may need to complete an application to the bank. Sometimes the application can be done by letter, but many banks provide standard forms. This application exists for two big reasons. First reason, it tells the bank exactly who must be paid and how much must be paid. Second reason, it creates documentary evidence and control, so the business can prove who requested the draft, why it was requested, and who approved it. On the application, the accounts clerk will normally include the name of the supplier, meaning who the draft is payable to, the amount in figures and in words, for example, $33,334.45. The business bank account details, meaning which account will be used to fund the draft. The reason for payment, for example, purchase of motor vehicle. Sometimes the bank also charges a fee, and the application helps record that. Teacher note for students. If an exam asks, what document is prepared first when paying by banker's draft, your answer is an application or request to the bank for the draft, usually on a standard form. Step 2. Signatures of authorized officials. The lesson says signatures will probably be needed, often 2 signatures. This is internal control. A large payment should never be approved by only one person, because that creates a risk of fraud or mistake. So the company sets a rule, for example. Payments above a certain limit need 2 authorized signatures. This protects the business in 3 ways. 1, it prevents one person from taking money without permission. 2, it reduces human error because 2 people review the details. 3, it creates accountability because the signers can be identified later. Teacher note for students. In exams, when you see a payment method that is high risk or high value, always mention authorization and signatures as a control. Step 3. Send the signed form to the bank. After the form is completed and signed, it is sent to the bank. This step matters because the bank must not issue a banker's draft based on a casual phone call or a verbal request. The bank needs written evidence. Teacher note: this is another control point. Written instruction reduces disputes and reduces fraud risk. Step 4. The bank returns the form and issues the draft. After the bank processes the request, the bank returns the form and the draft itself. This moment is extremely important. Once the draft is issued, the payment is basically locked in. Remember the rule again. A banker's draft cannot be stopped or canceled after it has been issued. So at this stage, the company must treat the draft like a valuable asset. If it is lost, it becomes a serious problem because the bank cannot simply cancel it in the same way as stopping a check. Step 5. Sign to acknowledge receipt of the draft, then send that confirmation back to the bank. This step is about control and proof. The bank wants evidence that the business received the draft safely and the draft has been collected by an authorized person. So the business signs to acknowledge receipt and sends that back to the bank. This reduces the risk of a later argument, such as, "We never received the draft," or "The draft was issued, but someone stole it before we got it." Teacher note: in an exam, if asked, "Why do we sign to acknowledge receipt?" you say, "To provide control evidence and confirm safe custody of the draft." Step 6. Send or take the draft to the supplier. Now the company delivers the draft to the car supplier. When the supplier receives the draft, they can release the car to the company because payment is guaranteed. Teacher note for students: this step is the practical business purpose of the banker's draft. It builds trust and reduces risk for the supplier. Important controls students must remember. Because a banker's draft is close to cash, a business should control it carefully. Keep it secure, for example, locked storage, limited access. Record the draft number, date, payee name, and amount in the payment records. Deliver it safely, for example, by trusted delivery or tracked method if posted. Keep documentary evidence, such as the application, approvals, and confirmation of receipt. How to answer exam questions on banker's drafts. Here is a simple exam method that works almost every time. Step 1. Define it in one line. A banker's draft is a payment method issued by a bank, payable to a named supplier, and it guarantees payment. Step 2. State the key feature. It cannot be stopped or canceled after issue. Step 3. State when it is used. Usually for large payments, for example buying a car, where the supplier wants guaranteed funds. Step 4. Outline the procedure in order. Application to bank. Authorize signatures. Send form to bank. Bank issues draft. Company acknowledges receipt. Company delivers draft to supplier. Step 5. Add 1 or 2 internal controls. 2 signatures for authorization. Secure custody because it is like cash. Application for inland draft. What this document is. An application for an inland draft is a request from the company to its bank. The company is asking the bank to create a bank draft payable to a supplier. This is used when the supplier wants guaranteed payment, especially for a large purchase such as a vehicle. Why it matters. A company check can bounce if there is not enough money. A bank draft is normally treated as safer because the bank issues it, and the bank will only issue it after taking the money from the company or confirming funds. Now let us go line by line. 1. Title. Application for inland draft. This tells you the purpose immediately. It is not a normal check. It is a request for the bank to produce a bank draft. 2. To Swallows Bank and the branch name, for example, Edgeware. This tells you which bank and which branch is responsible. In internal control terms, it creates accountability. If something goes wrong, you know which branch processed the request. 3. Date, written as 3.6.x7. This is the date the request is being made. Why the date matters. It proves timing. It helps match the request to later bank statements and to the date on the draft. 4. Kindly supply a cross-draft and account payee wording. This is a control feature. Cross-draft, meaning a cross-draft is intended to be paid into a bank account, not cashed over the counter. It reduces theft risk. If someone steals the draft, it is harder for them to turn it into cash. Account payee, meaning account payee means it should only be paid into the account of the named payee. Again, it reduces fraud risk. In exams, if you see crossed or account payee, you should immediately think security and fraud prevention. 5. Payable to. Fittipaldi Motors. This is the supplier, the person or business that must receive the money. This is a key field. If it is wrong, the draft may pay the wrong party. Exam technique. When asked, what is the payee, you answer, the supplier named on the draft, and you explain that the payee is the only party that should benefit from the payment. 6. Amount in figures shown as $33,334.45. Why the amount appears in this request? The bank needs the exact value to prepare the draft. The bank also uses this amount to debit the company's bank account. 7. Amount in words. On the form it is written like $33,334.45. Why we write the amount in words as well as figures? This is a classic control. If someone changes a digit in the numbers box, the words can reveal the true intended amount. In many payment documents, the words are treated as the legal amount if there is a conflict. Exam technique. If the examiner asks, why show the amount twice, you answer, to reduce fraud and errors and to confirm the correct amount. 8. Please debit my or our account number, followed by the account number. This tells the bank how the company will fund the draft. Debit my or our account, meaning the bank will take the money from the company's account. This is why a bank draft is considered safer for the supplier. The bank will not usually issue the draft unless the money is available. 82374116. 9. Herewith cash to cover and herewith check to cover type options. These options show other ways the company could pay the bank for the draft. 3 common funding methods exist. 1. Debit the company's bank account. 2. Give cash to the bank. 3. Give a check to the bank. In this example, the key instruction is the debit to the company account, so the other options are not used. 10. Charges. Many banks charge a fee for issuing a bank draft. This line tells the bank who pays the fee. Typical accounting point for students. The fee is usually an expense of the business. For example, bank charges. It will appear on the bank statement and is recorded in the books. 11. Signatures, often 2 signatures. This is one of the strongest controls. Why signatures matter. The bank needs proof that the request is authorized. The company needs proof that the request was not made by an unauthorized employee. Why 2 signatures may be required. Many organizations require 2 authorized signatories for large payments. It reduces fraud risk. One person alone cannot create a large payment without a second person approving. Exam technique. If asked, why are signatures required? Answer, authorization and internal control. 12. Acknowledgement of receipt of the draft number. The form includes a statement like, we acknowledge receipt of the above-mentioned draft numbered, meaning when the bank produces the draft, the company confirms it has received it. This creates an audit trail. Why the draft number is important. It is a unique reference. It helps tracking, matching, and investigation if the draft is lost. Document 2. The bank draft shown below the form. What this document is. This is the payment instrument itself, created by the bank. It is payable to the supplier. The supplier treats it as secure because it is issued by the bank, not written by the company. Now let us read the key parts. 1. Bank name. Swallows Bank. This shows the issuer. Because the bank issues it, the supplier trusts it more than a normal company check. 2. Branch details. For example, head office and branch name. This identifies where it was issued and supports verification. 3. Payee name. Fittipaldi Motors Limited. This must match the supplier the company intends to pay. Control message to students. Always check the payee name. A common fraud is changing the payee name. 4. Not negotiable style marking. This is a security feature. It indicates that the draft is not meant to be freely transferred to other parties like cash. It reduces theft and misuse. 5. Date written as 4th June 20x7. This is the issue date of the draft. Why the date matters. It affects timing and record keeping. It helps matching to the bank statement and to the purchase invoice date. 6. Amount in words. It states something like $33,334.45 only. Why only is written. It prevents someone adding extra words after the amount. It is anti-fraud. 7. Amount in figures. It shows the same amount in the amount box, again as a control. To compare words and figures. If they do not match, you treat it as a red flag that needs investigation. 8. Draft number and bank codes, often printed along the bottom. These are for processing and tracing. 9. Bank officer's signature or authorization mark. This shows the bank has authorized the draft. Without bank authorization, the draft is not valid. How this links to accounting records. When the draft is issued, what happens in the company's books? The company's bank account decreases. The liability to the supplier decreases if it was already recorded as a payable. If it was not yet recorded, then the payment will be recorded with the related purchase. The bank statement will usually show the amount of the draft, plus any bank fee. The bank fee is recorded as bank charges expense. How exam questions are usually asked and how to answer. 1. Identify the document. The examiner may show the form and ask, "What is this used for?" Answer: it is a request to the bank to issue a bank draft for secure payment to a supplier. 2. Explain the controls. They may ask, "Why crossed account payee and signatures?" Answer in simple control language to prevent theft, reduce fraud, and ensure only authorized payments are made. 3. Traceability. They may ask, "Why do we need the draft number and acknowledgement?" Answer: audit trail, tracking, and evidence that the draft was issued and received. 4. Funding method. They may ask, "How is it paid for?" Answer: the bank debits the company's account, or the company provides cash or check, depending on the option selected. 5. Advantages and disadvantages compared with company checks. Expected points. Advantage: supplier confidence and reduced risk of bounced payment. Disadvantage: fees and administrative steps, and drafts can be difficult to cancel once issued. Common student mistakes and how to correct them. Mistake 1. Confusing bank draft with bank overdraft. Correction: draft is a payment instrument. Overdraft is borrowing. Mistake 2. Ignoring the word's amount and reading only the figures. Correction: always check both. Words are there to prevent tampering. Mistake 3. Forgetting why signatures matter. Correction: signatures mean authorization. 2 signatures means stronger internal control for higher value payments. Mistake 4. Not mentioning the bank fee. Correction: in real life and in exams, mention that banks often charge for drafts, and that fee is recorded as bank charges. Lesson 9 is about 2 bank-based ways to make regular payments without writing a new check every time. The 2 methods are standing order, direct debit. Both methods reduce routine work, but they also create a control risk. Because once the arrangement is set up, payments can happen automatically. So the key control point is the setup, approval, and ongoing review. This lesson also reminds you of something important. Standing orders and direct debits were discussed earlier in the book when a business is receiving money. Here, we look at them from the viewpoint of a business making payments. Lesson 9.1. Standing orders. What a standing order means in simple words. A standing order is an instruction given by the payer to the payer's bank. It tells the bank to pay a fixed amount on fixed dates to a specific payee. Think of it like this. You are telling your bank, "Please send this amount every month to this person or company until I tell you to change it." Why a business uses standing orders? Standing orders are mainly used when the payment is regular and the amount is fixed. 2 common examples are rent payments to a landlord for a building occupied by the business, insurance premiums paid to an insurance company. The key feature to remember: with a standing order, the payer controls the payment. The payer decides the amount. The payer decides the date. The payer decides the frequency. Even if the supplier requests payment by standing order, it is still the paying business that must ask its bank to set it up. What the business must tell the bank to set it up correctly. To create a standing order, the business must clearly specify the following items. First, the business wants a standing order arrangement for regular payments from its bank account. This tells the bank the payment is not a one-time transfer. Second, the fixed amount of each payment. This is crucial because the bank will repeat exactly what is written. Third, the frequency and the date of each payment. For example, monthly on a specific day or weekly on a specific day. Fourth, the banking details of the supplier, meaning the payee. This ensures the money goes to the correct bank account. If any of these items are wrong, the payment may go to the wrong place, go on the wrong date, or go for the wrong amount. How the request is made in practice. A business can ask the bank in writing by letter, but banks often provide a standard form. That standard form is commonly called a standing order mandate. Why a standard form is useful. It forces the business to complete all required details. It reduces the risk of missing key information. It gives the bank a format they recognize and can process quickly. Authorization control for standing orders. This is very important for Chapter 8. A standing order is a payment arrangement, so it must be authorized properly. In practice, the standing order request usually needs to be signed by someone with authority. Typically, that is the chief accountant or a director. The bank often requires a signature from an authorized check signatory, meaning someone whose signature the bank already recognizes for the company account. An accounts clerk might prepare the form, but the clerk should not be the person who approves it unless the company policy allows it. This is part of good internal control. Preparation and approval should not be done by the same person when possible. How to change or stop a standing order. Sometimes a business needs to change the amount, or change the payment date, or stop future payments. When that happens, the business must send instructions to the bank in writing. This is emphasized because the bank is acting based on the original written authority, so the bank needs written authority to change it. A simple real-life example to make it very clear. Imagine the business pays rent of $1,000 each month. The landlord wants the rent on the first day of every month. The business sets up a standing order with these instructions. Pay $1,000. Pay monthly. Pay on the first day of each month. Pay to the landlord's bank account details. After that, the bank pays it automatically each month. The business then checks the bank statement and records the payment in its books. Exam approach for standing orders. When you see an exam scenario, look for these clues. The payment is regular. The amount is fixed. The payer tells the bank to send the money. The payer chooses the date and frequency. If you see these clues, the best answer is often standing order. In an exam explanation, the highest scoring points usually include who initiates the payment, the payer initiates it, amount type, fixed amount, timing, regular on fixed dates, typical uses, rent, insurance premiums, control point, proper authorization at setup and written instruction to change or cancel, ongoing control, review bank statements and review the list of active standing orders. Lesson 9.2, Direct Debits. What a direct debit means in simple words. A direct debit is a payment method where the payee collects money from the payer's bank account, but the payee can only do that because the payer has given advance permission. So the payer authorizes the arrangement once, and then the supplier can collect payments as they become due. The key feature to remember: with a direct debit, the payee controls the collection. The supplier initiates each payment collection. How direct debits are different from standing orders. The text gives two core differences. First difference: who initiates each payment? With direct debit, the person who receives the payment initiates each payment. They tell the paying bank the amount to collect. Second difference: the amount pattern. With direct debit, payments can be for a variable amount each time. Payments can also happen at irregular intervals. Direct debits can also be fixed at regular intervals. But the important point is that variable and irregular are allowed. Why businesses may use direct debits. The text notes that direct debits are not often used by businesses for payments, but they may be used for convenience in some cases. A common situation is regular bills, such as telephone bills, gas bills, electricity bills, water bills. These bills are often not the same amount every time. That is why direct debit fits well. How the business knows what will be taken. The company receiving payment by direct debit will usually inform the payer of the amount and date. This might be done through a printed statement. The point is that the payer is informed before or as the payment is collected, depending on the billing arrangement. How a business sets up a direct debit. If a business decides it wants to pay some bills by direct debit, it must complete a direct debit instruction. This is the formal permission document. The usual flow is, the business completes the direct debit instruction with its bank account details and approval. The business sends it back to the supplier. The supplier then makes arrangements through its own bank to set up the direct debit collection. This is a key control point. Once set up, money can be taken automatically. So the business must ensure the instruction is properly authorized before it is sent. Controls and risks for direct debits. Because the supplier initiates the payment, the risk is different from standing orders. Common risks include: the supplier collects the wrong amount by mistake. The supplier collects on the wrong date. A direct debit continues even after the service is canceled. A fraudulent direct debit is set up if controls are weak. So businesses should apply practical controls, such as only authorized staff can approve a new direct debit instruction. The business keeps a list of active direct debits and reviews it regularly. The business matches each collection to the supplier bill or statement. The business investigates unusual amounts quickly. A simple real-life example to make it very clear. Imagine the business has an electricity bill every month. Some months it is higher. Some months it is lower. The business signs a direct debit instruction once. Then the electricity supplier collects the bill amount each month. The business checks the supplier statement and matches it to what was taken from the bank. Exam approach for direct debits. In an exam scenario, look for these clues. The supplier collects the money from the business account. The amount can change each time. The payment is linked to bills like utilities. There is a direct debit instruction or an authorization to allow the supplier to collect. If you see these clues, the best answer is often direct debit. In an exam explanation, high scoring points usually include: who initiates the payment? The supplier initiates each collection. Amount type, often variable. Timing, can be regular or irregular. Documentation, a direct debit instruction must be completed and authorized. Control point, strong approval at setup and regular checking of bank statement against supplier statements. Extra note included at the end of the lesson. The page also reminds students that other bank-based payment methods exist. Large sums may be paid by telegraphic transfer or interbank transfer. This normally happens based on written instructions given to the bank. The bank transfers funds directly to the payee bank. Many companies now use internet banking to pay suppliers and employees online. The funds normally arrive in the payee's account about 2 working days after they are debited from the payer's account. How to answer Lesson 9 questions in an exam. A simple method that works. Step 1. Identify the pattern. Ask, is the payment regular and is the amount fixed or variable? Step 2. Identify who initiates. If the payer instructs the bank to pay, think standing order. If the supplier collects from the payer, think direct debit. Step 3. State the document and control. Standing order uses a standing order mandate or written instruction to the bank approved by an authorized signatory. Direct debit uses a direct debit instruction authorized by the payer and set up through the supplier's bank. Step 4. Add practical examples. Standing order example. Rent and insurance premiums. Direct debit example. Utilities such as electricity and telephone. You are told that a business called Libra needs to make 5 different payments. Each payment situation is different. Your task is to choose the most appropriate method of payment for each situation. Then you must give a reason for your choice. So, for each part, you must do 2 things. First, name the best payment method. Second, explain why that method is best for that situation. The 5 situations are these. Part A. Libra needs to pay $6.29 for office cleaning materials bought from a nearby supermarket. Part B. Libra needs to pay $534.21 to Southern Electric for the most recent quarter's electricity bill and standing charge. A bank Giro credit form, also called a payment counterfoil, is attached to the bill. There is no direct debit mandate in place at the moment. Part C. Libra needs to pay $1,615 each month for 10 months for business local taxes payable to Clapperton District Authority. This authority operates a direct debiting system. Part D. Libra needs to pay $186.60 to rent and hire for 1-week car hire on company business by the sales director at Edinburgh Airport. The sales director must pay on the spot and does not want to use a personal check or cash. Part E. Libra needs to pay $23,425 to Selham Motors for a new car for the finance director. Selham Motors will not accept one of the company's checks because the finance director wants to collect the vehicle immediately when paying in person, and Selham Motors is worried that a check might be dishonored. Part A. Paying $6.29 for cleaning materials from a nearby supermarket. Recommended method, cash, usually from petty cash. Why cash is the best answer here? This is a very small amount. For very small purchases, businesses normally use petty cash. Petty cash is a small box or float of cash kept in the office for low-value day-to-day items, like cleaning materials, tea, coffee, stamps, or small stationery. If you tried to pay $6.29 by check, it would be slow and inconvenient. The supermarket may not even accept a check. If you tried to pay by bank transfer, it would take longer, and it creates unnecessary paperwork for a very small item. What the business still must do for control. Even though the method is cash, the business still needs evidence and control. The person who buys the materials should bring back the receipt. The petty cash custodian should keep the receipt as proof. Many businesses also use a petty cash voucher showing who took the money, what it was for, and the amount. So the key exam idea is this: small value, local purchase, immediate payment, simple evidence equals petty cash. Part B. Paying $534.21 to the electricity supplier with a bank giro credit form attached and no direct debit mandate. Recommended method: pay by check at the bank, using the bank giro credit form or payment counterfoil. What the question is telling you: this bill has a bank giro credit form attached. That is an instruction slip that helps the bank process the payment correctly. It includes the supplier's bank details and the reference that identifies the customer account. It is designed to be paid through a bank. Also, the question clearly says there is no direct debit mandate in force, so you cannot choose direct debit yet. Why a check at the bank is appropriate? The amount is not tiny. It is $534.21. Paying a larger bill in cash is risky. Cash can be lost or stolen. Cash is also harder to control because you must physically carry it and count it. A check is safer than cash for a larger payment because it creates a clear audit trail. The payment can be traced through the bank statement. Also, when paying at the bank with the bank giro credit form, the bank clerk can stamp the bill or the counterfoil. That stamp is strong evidence that the bill was paid. So the logic is, the supplier provided the correct banking document. Use that document. Pay through the bank. Use a check rather than cash, because the amount is large and control matters. Extra point that often appears in exam answers. If Libra pays at a bank that is not its own bank, that bank may charge a small processing fee. This is not the main reason for the method, but it is a sensible practical comment. Alternative that is sometimes acceptable. Another acceptable method is to send a cross-check by post enclosing the payment counterfoil. A cross-check is safer because it must be paid into a bank account, not cashed over the counter. But the model answer chooses paying at the bank because it gives immediate evidence and reduces the risk of postal delay. Part C. Paying $1,615 monthly for 10 months to a local authority that operates a direct debiting system. Recommended method: direct debit mandate. What the situation looks like. This is a regular payment. It happens every month. It lasts for 10 months. The payee is a local authority, and the question says they operate a direct debiting system. That is a very strong clue that direct debit is the best method. Why direct debit is the best answer? Direct debit is designed for regular payments. Once a direct debit mandate is set up, the authority can collect the amounts on the due dates automatically from Libra's bank account. This reduces administrative work. Libra does not need to write and sign a check every month. Libra does not need to remember each due date. It reduces the risk of late payment penalties. Also, because the authority operates the system, they will normally give notice of the amounts they will collect. The mandate continues until it is canceled, so it works perfectly for a series of payments like this. So the exam logic is regular, repeating, same payee. The payee supports direct debit. That equals direct debit mandate. Part D. Paying $186.60 for a week's car hire at an airport must be paid on the spot, and the sales director does not want to use a personal check or cash. Recommended method: credit card or charge card. Why this is the best answer? The most important clues are pay on the spot and airport. At an airport, the supplier expects fast payment. They will usually accept cards quickly and easily. The sales director does not want to use cash. That is sensible because carrying cash while traveling is risky and you might not have the exact amount. The sales director does not want to use a personal check. That is also sensible because many businesses will not accept a personal check, especially for an immediate rental transaction, because it can be dishonored. A credit card or charge card solves all of this. It is widely accepted for travel and car hire. It allows immediate payment. It creates a record on the monthly statement. It is safer than cash. How the business handles it in practice. If the company has a company card, the director should use that. If the director uses a personal card, they can claim the cost back through an expenses claim later. The company can then reimburse them, usually by bank transfer or check. So the exam logic is immediate payment required. Supplier likely expects a card. Cash and checks are inconvenient or unacceptable. That equals credit card or charge card. Part E. Paying $23,425 for a new car. Supplier will not accept the company's checks. The buyer wants to collect immediately, and the supplier is concerned a check might be dishonored. Recommended method, banker's draft. What the problem is here? This is a very large amount. The supplier refuses company checks. The supplier wants guaranteed funds before releasing the car immediately. So you need a method that is trusted like cash, but safer than carrying cash. Why banker's draft is the best answer? A banker's draft is issued by the bank. It is effectively a check drawn by the bank, not by the customer. Because the bank issues it, the payment is considered guaranteed as long as it is genuine. A key point is that a banker's draft normally cannot be stopped or canceled after it has been issued, unlike ordinary checks. That is why the supplier trusts it. It is treated almost like cash, so the supplier is confident. They will release the vehicle immediately, and Libra avoids the risk and impracticality of carrying cash. So the exam logic is very large amount. Immediate collection. Supplier refuses ordinary check. Supplier needs guaranteed payment. That equals banker's draft. How to handle similar exam questions. In exam questions like this, you win marks by matching the method to the clues. Use this simple checklist for each part. 1. How big is the payment? Small payments usually suit petty cash. Large payments need safer methods with strong control. 2. Is it urgent or must it be paid on the spot? If yes, think card payments or guaranteed instruments like banker's draft for very large purchases. 3. Is it regular and repeating? If yes, think standing order or direct debit. If the payee operates direct debit, that is often the best choice. 4. What does the supplier accept and what documents are provided? If a bank Giro credit form is attached, that is telling you to pay through the bank using that reference. If the supplier refuses company checks, you must choose a different method. 5. What evidence and control does the method provide? Checks, cards, and direct debit all create bank statement evidence. Cash must be supported by receipts and petty cash controls. 10. Documentation to go out with payments. In this lesson, we are not talking about the payment method itself, like cash, check, or bank transfer. We are talking about the paperwork that should travel with the payment, so the supplier clearly understands what the money is for, and so the business can keep clean records. Why this lesson matters. When a supplier receives money, they ask two basic questions. First question, what is this payment for? Second question, which invoices should I mark as paid? If the supplier cannot answer those two questions, problems start. The supplier may post the payment to the wrong invoice. The supplier may think you did not pay at all, and they may send reminders. The supplier may charge interest or late fees because their system shows the invoice is still unpaid. Your business may waste time arguing, phoning, emailing, and searching for evidence. Your accounts payable ledger may not match the supplier's statement. So lesson 10 is about preventing confusion before it happens. Good documentation saves time, avoids disputes, and protects the business. The big idea. A business should send proper explanatory documentation with all payments, and copies of the relevant documents should be filed in a way that they are easy to retrieve later. That means two things are happening at the same time. 1, you send something to the supplier so they can allocate the payment correctly. 2, you keep copies in your files so you can prove what happened later. Both parts are important. What explanatory documentation means. Explanatory documentation is any document that clearly tells the supplier who is paying, who is being paid, what invoices, orders, or charges the payment relates to, how much is being paid, when the payment was made, what reference number or customer account number to use. Think of it like a label on a parcel. If the label is missing, the parcel still arrives, but nobody knows where it should go. Why filing copies is a control, not just paperwork. Many new students think filing is not important. In real businesses, filing is part of internal control. It helps with evidence for audit. You can show what was paid and why. Checking supplier statements. You can compare your records to theirs. Handling disputes. If a supplier says you did not pay, you can quickly prove the payment and what it related to. Stopping duplicate payments. If you cannot find records, you might accidentally pay the same invoice twice. Staff continuity. If the accounts clerk is absent, another person can still understand the payment history. So filing is not for decoration. Filing is for control and accuracy. The usual situation when a payment is made. Most payments to suppliers are made after an invoice is received, but suppliers often have many invoices outstanding at the same time. So if you simply send money with no explanation, the supplier might guess, and guessing causes errors. That is why Lesson 10 lists common documents that may go out with payments. The main documents that can go out with a payment. Lesson 10 gives 5 common examples. I will explain each one in simple terms and when it is used. 1. Remittance advice. A remittance advice is a note that tells the supplier exactly how you want them to allocate the payment. It usually lists the invoice numbers being paid and the amounts for each invoice. It is especially helpful when you are paying several invoices in one payment. You are paying one invoice, but deducting something like a credit note. You want the supplier to apply the payment to specific invoices in a specific way. Important point. You do not need to know every field of the remittance advice here, because that belongs to Lesson 10.1. For Lesson 10 only, you need to know the purpose. Its purpose is clear allocation of the payment. Order form sent with the order itself. Sometimes a payment is connected to an order rather than an invoice. For example, you might be paying for goods that are being ordered, or paying a deposit. An order form is used to show what items were ordered, quantities and prices, delivery details, the order reference that the supplier should use. So if you send a payment with an order form, the supplier can match the money to the order reference, even if an invoice has not arrived yet. This is common in situations like deposits for special orders, advance payment for certain suppliers, mail order or online orders where the supplier needs the order reference to trace the payment. 3. Copy of a pro forma invoice. A pro forma invoice is like a request for payment issued before the real sales invoice. It is often used when the supplier wants payment before supplying the goods. So if you pay based on a pro forma invoice, you may send a copy of that pro forma invoice with the payment. This helps the supplier because they can identify the customer and the amount requested. They can match the payment to the pro forma invoice reference. They can then release the goods or provide the service. In simple words, a pro forma invoice is often used for pay first, then receive the goods. 4. Bank Giro Credit Form for utility-type bills. Some bills, like telephone, electricity, and similar services, may come with a Bank Giro Credit Form. This form is designed to help the payment go to correct supplier account with the correct reference. It helps avoid mistakes because it typically includes the supplier's bank receiving details, a reference linked to the customer account, a tear-off part that can act as proof of payment. This is useful because utilities have thousands of customers. If the reference is missing, the supplier may receive the money but not know whose account to credit. So the Bank Giro Credit Form is a way of saying, here is the money, and here is exactly where it belongs in your system. 5. Covering letter. A covering letter is used when none of the other documents are available or when extra explanation is needed. For example, you are paying an unusual charge and want to explain it clearly. You are paying a part payment and want to explain what remains unpaid. You are making a correction, such as paying the balance after a credit note. You are paying without an invoice, and you need to explain what evidence supports the payment. A covering letter should be simple and clear. It should say what the payment is for and which references apply. In teacher terms, a covering letter is the backup explanation document, how a business chooses what to send. A very practical rule is this: send the document that makes it easiest for the supplier to post the payment correctly. If there are invoice numbers, send something that lists the invoice numbers. If there is an order reference, send the order reference document. If the supplier gave a special payment slip, use that slip. If the situation is unusual, add a covering letter. The goal is always the same: no confusion for the supplier, no confusion for your own records later. What good documentation prevents? Let us connect Lesson 10 to real problems. Problem 1. Supplier says you did not pay. If you have a copy of the remittance advice or the payment note, you can prove what invoices you intended to pay. Problem 2. Supplier allocates the payment to the wrong invoice. Clear references prevent misallocation. Problem 3. You cannot match your purchase ledger to the supplier statement. If your payment documents are filed properly, you can reconcile quickly. Problem 4. Duplicate payment. Good filing helps you see that the invoice has already been paid. Problem 5. Fraud risk. When payments are supported by proper documentation, it is harder for an employee to create fake payments because every payment must be tied to real paperwork. Filing and retrieval in a simple workflow. Here is a clean way to think about filing in a way students can remember. Step 1. Collect the supporting documents. This might include the invoice, credit note, order form, or supplier statement. Step 2. Approve the payment internally. Someone checks that the goods or services were received, the price is correct, and the payment is authorized. Step 3. Make the payment. Check, bank transfer, or other method. Step 4. Send the explanatory document with the payment. Remittance advice, bank giro credit form, or covering letter. Step 5. File copies in a sensible order. Many businesses file by supplier name, then by date. Some file by payment number, then attach all related documents behind it. The key requirement is simple. When someone asks later, "Why did we pay this?" you can find the answer quickly. Exam focus for Lesson 10. In an exam, Lesson 10 often tests your understanding of control and documentation. Markers look for points like: payments should be supported by documentation so the supplier can allocate correctly. Documentation creates an audit trail. Copies should be filed so records can be retrieved easily. Examples of documentation include remittance advice, order form, pro forma invoice copy, bank giro credit form, and covering letter. A common mistake students make is this: they talk only about payment methods, and they ignore the documents that go with the payment. Lesson 10 is specifically about the documents. Final teaching summary. Lesson 10 is about communication and control. You communicate to the supplier what the payment is for. You control your own records by filing copies in a retrievable way. If students remember one sentence, let it be this: every payment should travel with a clear explanation, and every payment should leave behind clear evidence. Lesson 10.1 is about remittance advices. A remittance advice is a simple document that goes with a payment to a supplier. Its job is to clearly answer two questions for the supplier. First question: who is paying you? Second question: which invoices is this payment paying? When suppliers receive money, they must match that money to the correct invoices in their records. If they cannot match it, they may think you did not pay, even when you did pay. That is why a remittance advice is so important. It reduces confusion, reduces phone calls, and reduces disputes such as "we paid" versus "we did not receive the payment for invoice number." A remittance advice is especially useful when you pay one supplier for many invoices at the same time, or when there's a credit note that reduces the amount you need to pay. Now I will explain what information a remittance advice should include and why each item matters. The remittance advice should include the name and address of the customer, meaning the customer is the business that is paying. Why it matters: the supplier may have many customers with similar names. The address helps confirm the correct customer account. The remittance advice should include the name and address of the supplier, meaning the supplier is the business receiving the money. Why it matters: it confirms the remittance advice is intended for that supplier, not for another one. The remittance advice should include the customer's account number or customer code as specified by the supplier. meaning many suppliers give each customer an account reference. Why it matters. The supplier can quickly locate your account in their system and post the payment to the right place. The remittance advice may also include the supplier code as specified by the customer. Meaning, this is the code the customer uses inside their own accounting system to identify that supplier. Why it matters. It helps the customer file the document correctly and retrieve it later. It also helps the accounts department avoid mixing suppliers up. The remittance advice should include the invoice number or invoice numbers. Meaning, each invoice has its own unique number. Why it matters. This is the strongest way to match a payment to a specific invoice. The remittance advice should include the invoice amount or invoice amounts. Meaning, the value of each invoice being paid. Why it matters. It shows exactly how much is being settled for each invoice. This is helpful if one invoice is partially paid or if there is a disagreement. The remittance advice should include the invoice date or invoice dates. Meaning, the date each invoice was issued. Why it matters. Some suppliers file invoices by date. It also helps verify you are talking about the same invoice. The remittance advice should include the date of payment. Meaning, the date you made the payment, for example, the date the check was prepared or the bank transfer was made. Why it matters. If the supplier says the payment has not arrived, the payment date helps track timing and investigate. The remittance advice should include the total amount of the payment. Meaning, the final amount you are sending after considering invoices and any credit notes. Why it matters. The supplier can check that the money received equals the total shown on the remittance advice. Now let us address an important point. Sometimes there might be two remittance advices involved. One remittance advice might come from the supplier. For example, it might be attached to the supplier's statement. It may be a separate form or a tear-off slip on the statement. Why this happens. The supplier wants you to tell them exactly what you are paying, and they provide a format to make it easy. A second remittance advice might be prepared by the customer's accounts department. This one is sent to the supplier with the payment, and a copy is kept by the customer for reference. Why this happens. The customer wants a clean internal record of what was paid, when it was paid, and which invoices were included. Now I will walk you through the example remittance advice shown in the book. At the top, the document is titled Remittance Advice. This title tells the supplier immediately. This page explains what the payment is for. It is addressed to Rapid Supplies with an address shown. So Rapid Supplies is the supplier receiving payment. On the other side, it shows ABC Company with an address shown. So ABC Company is the customer making the payment. Then there is an account reference shown as 01RAP. This is a reference code. In simple words, it is an identity label. It helps the supplier or the customer quickly find the correct account in their accounting system. Then there is a date shown as 0506X7. This is the date of the remittance advice. Even if the format looks unusual, the key learning is this. A remittance advice must be dated so that it can be traced later. Then the remittance advice lists the items included in the payment. There are 3 invoices listed and then 1 credit note listed. A credit note is like a negative invoice. It reduces what you owe. So what does the remittance advice do with that credit note? It subtracts it from the total invoices. Let us check the totals shown at the bottom. Total invoices are $1,299.70. Total credit notes are $114.20. So the payment amount becomes $1,185.50. In teacher language, I would say it like this. We start with the full invoices total, then we subtract the credit note total. The result is the amount of money we actually send. So the remittance advice is giving the supplier a clear calculation trail. It is saying, we are paying invoices A, B, and C. We are also applying credit note D. Therefore, the money we send is the net amount. Now we must understand the filing and control side, because this is where students often get confused. When ABC Company sends the payment, the supplier should receive the remittance advice with the payment. If the payment is by check, the remittance advice goes in the same envelope with the check. If the payment is electronic, the remittance advice may be sent as an email or a separate letter, depending on the company system. A copy of the remittance advice should be kept by ABC Company. Why? So if Rapid Supplies later asks, which invoices did you pay? ABC Company can immediately open the file and prove exactly what was included. The book also notes a practical detail about supplier codes. A supplier code is the code ABC Company uses inside its own accounting system to identify Rapid Supplies. So you may see a code on the remittance advice that is not meaningful to the supplier, but it is meaningful to the customer for filing and retrieval. Finally, there is an important practical point about extra remittance advices. Sometimes the supplier sends remittance advices with each invoice and credit note. If that happens, those supplier remittance advices should also be sent back with the payment. So the letter to the supplier might contain 3 items. One item, the check. Second item, ABC Company's own remittance advice prepared by its accounts clerk. Third item, the remittance advice slips provided by Rapid Supplies. This creates a strong audit trail. It makes it easy for both sides to post the payment correctly. It also supports good internal control because every payment is linked to documents.